100% probability of a recession within the next 12 months. I think Bloomberg Economics was saying much the same thing now. I think the consensus now is that we're in for a soft landing.
Anna Wong's model was calling for a 100% chance of recession this year, which I thought was, pretty aggressive.
Yeah, well, I mean, look, she wasn't alone, right? And so my point is, now, if you look at most recession indicators, they're calling for a soft landing, So something's obviously changed. Let's see if Powell can deliver and not, mess up the message.
I mean, look, last time he said September's live, he said they won't cut rates for years. So he is certainly more hawkish than the dot plot, for example.
Yeah.
Former President Donald Trump is back on Twitter. We're supposed to be calling it X now, but I don't think that's really going to stick. He posted his own mugshot in his first tweet on the site since he was banned in 2021. The post came after he was booked in the Fulton County Jail in Georgia last night. If I read the story right, the former president spent 20 minutes in jail. I don't think that means he was in a cage. But I think, I gotta say, a little editorialization here on style. Great mugshot.
Yeah, it's a great mugshot. I mean, look, Matt, the real question I have is President Trump or former President Trump back on Twitter, X, whatever you want to call it now? He used to have 86 million followers. He only has 6.7 million on Truth Social after the Tucker Carlson interview this week on X. I mean, is the former president back on X?
It looks like he's back.
Back on X.
And I know what I want to call it. Not X. China unveiling new mortgage policies aimed at halting a slump in its residential property market. The rules include more support for home buyers as they look to revive the world's second largest economy. And China has been, I think, slower than many market participants have expected in terms of the stimulus.
Yeah.
They are asking big banks to lend more, certainly in terms of mortgages. What's the story here?
It's not just big banks. They're asking to lend more. They're asking foreign investors to invest more. They've called a meeting. I think Goldman Sachs, Fidelity, some other big institutional investment managers are being invited to talk about why are they retreating from local equities in China. And so that's interesting. They've also offered, I think, to cut the stamp tax, the duty tax on foreign investment in stocks. So by cheapening the ability to invest in and own Chinese stocks, clearly there's some issues there. They want to bring foreigners back into the fold.
Let's, talk a little bit more about this. We've got Ian Shepherdson with us now, chief economist over at Pantheon Macroeconomics. And of course, I want to get to the Fed and the important speech from Jay Powell today with you, Ian. But first on China, we expected them to do a lot more after the reopening seemed fairly lackluster. Amrita Sen said to us just moments ago that at least gasoline demand is stronger than the other macros in the economy. What's going on over there, and what do you expect from the authorities?
Well, I think that the story of a really disappointing post-reopening rebound is real and will be sustained. I don't really see anything in the domestic economy to turn that around anytime soon. But the policy response, as you say, has been kind of piecemeal. It's been no sort of big bang events like we saw, after the crash in 2008 when China was extremely aggressive with huge stimulus. We haven't done that this time around. It's been much more gradual, much more let's try this and see if it works, let's try that and see if it works, and cross our fingers. And I think that probably continues for a while yet. Now, whether later down the road they are forced to do something much more aggressive is a kind of an open question. But the backdrop for all of this, I think, that everyone needs to appreciate is that China has some fundamentally really quite big problems which aren't going to go away anytime soon and aren't going to be fixed by small cuts in interest rates and shouting at banks to lend more to potential mortgage borrowers. They have a massively overburdened, massively over-indebted private sector. The public sector isn't, so they can't afford to bail it out if they need to. But the private sector is carrying this enormous burden of debt. The consumer doesn't want to spend. There's excess capacity in the manufacturing sector, so prices are falling, so that's hurting profits. It's a really big mess. Plus, of course, the problems with the commercial developers that we all know about. So can this be fixed quickly? No. Will it require more policy response? Yes. Are we going to wake up one day and find they've done something massive? Well, no sign of that yet.
We have, there's a great piece on the Bloomberg today by Liz McCormick about the fact that our current president here in the United States and the previous president have opted to, just pour fiscal stimulus into this economy. Right now, even though we're not in a recession, we're going to run a $1.6 trillion deficit. Is it possible that while Biden and Trump have opted to run the economy hot, spending trillions and trillions of dollars and building up a ton of debt. The President Xi is trying to break China's addiction to stimulus, trying to pull back on the debt-fueled growth model of his predecessors.
Oh, I'm sure that if he could wave some sort of magic wand and get the economy to grow more quickly, more sustainably, without aggressive fiscal action, then he would do it. And that's what they're doing right now by this drip-feeding the interest rate cuts and putting pressure on lenders and trying to attract foreign investors back into the stock market. These are all kind of in place of doing something more drastic. And they don't want to throw the consumer a huge pile of money. Their view is that when European and the US did that during the COVID pandemic, that was a mistake with consequences. They don't want to get people addicted to fiscal stimulus. But on the other hand, they do have to keep the economy growing. The last thing that the Chinese government wants to deal with, is tens of millions more unemployed young people. I mean, they've stopped publishing their youth unemployment rate. That's not an accident. It's very high, and it's likely to rise further. So there is a limit to how far they're willing to run this experiment of not doing more aggressive stimulus. Of course, what we don't know is where is that limit? When will the stimulus be ramped up, and what form will it take? Clearly not yet. I mean, they're still in the let's try and do this in a piecemeal sort of mode, but there is a very clearly the Chinese authorities' position depends on maintaining some degree of growth in the economy. Now, the about 5% target for this year is going to be very difficult, so they'll have to do more.
Dr. Shepperson, I wonder if you can square all that fiscal stimulus in the U.S. that Matt is referring to, the CHIPS Act, the Inflation Reduction Act, with student loans here in the U.S. and what the more immediate impact will be on inflation and on productivity.
Yeah, so the impact of the CHIPS Act and the IRA has clearly boosted commercial construction in the U.S., manufacturing construction's boosted manufacturing jobs. It's been quite a big event. But at the margin, of course, that becomes less important going into next year. The big bang for the buck comes in the first year. And from October, of course, the student loan repayments start again, which is about 1% of personal income if people choose to start paying it all off at once, which is a big hit. Consumption is 70% of GDP, and taking out that amount of money from the economy overnight potentially is a threat. And this is why I'm very nervous about all these sort of blasé declarations that, well, the recession risk is over, it's definitely going to be a soft landing, we don't need to worry anymore. That makes me nervous. We just don't know how people are going to behave when the loan repayments start. We do know that the excess savings that people built up during the pandemic, which was as a result of very generous fiscal policy, though 3/4 of that money is now being spent. Plus, of course, what everyone doesn't want to talk about, the Fed's raised rates by 525 basis points, and lags are a thing. It takes time, and longer than markets wanted to take, and longer than the media wanted to take, for interest rates to work through. So I think the idea that we've now suffered all the pain we're going to feel from those rate hikes is delusional. Whether the lagged effect is enough to trigger a recession, it's a different question, but I think it's far too premature now to make the judgment that the risk is over, that's for sure.
Dr. Shepperson, do you feel that markets currently underestimate the Fed's determination to normalize policy? And if so, what does it mean for 10-year yields?
Oh, I think markets get it now. I mean, there was a period, last year when markets really didn't get it, and I think Chair Powell, including the Jackson Hole speech last year, made it very clear the Fed would do whatever it takes. And now that inflation is falling, unambiguously, the core rate's coming down very nicely, and even some of the sticky things in services are looking better now. So my guess is that this track will continue. I don't think it's just some sort of flash in the pan. I think it's a sustained disinflation. But I don't expect Chair Powell today to declare any sort of victory. I think he will want to retain optionality, just in case things go wrong again. I mean, we've been disappointed over the last couple of years when we get good numbers followed by bad numbers. So we've all learned that lesson. He's not going to say we're done. He's not going to start promising rate cuts anytime soon. But I think ultimately there comes a point in every economic cycle where the market says, oh, okay, Fed, you're talking tough, but actually we think that you've done what you need to do now. And at that point, we see yields rallying. So I see a fair bit of scope now between now and the year end for the 10-year to make a fair bit of progress. I'd be really disappointed if we didn't get meaningfully below 3% by the end of the year. And I would hope that by the time we get to the middle of next year, it'll be more like 350. So definitely improving, but again, we just need to be cautious. Chair Powell is not going to wave the victory flag today.
I think we all agree he's not going to change the inflation goal as well. 2%, will keep it there. But why would they want to raise it anyway? I mean, it's a regressive tax on the poor. It's as violent as a mugger, as frightening as an armed robber, as deadly as a hitman, according to Ronald Reagan. Why would anyone think it's okay to run inflation at 3%?
Well, I don't think it's okay to run it at 3. I mean, I probably wouldn't object if they raised the target to 2.5. 3 makes me a little bit nervous. I mean, remember when the target was set to 2% back in 2012, inflation was persistently below that level. So it was an idea that it was a signal that we would get it up rather than run the risk of a Japanese-style deflation, which was a significant concern for quite a while. So the context has changed during which the inflation target was set. Lots of other countries have targets which maybe are at a range 1 to 3, something like that. It seems to work perfectly well. But I completely agree with you. Sustained inflation is a really bad thing. Even Keynes, the much maligned Keynes, said that inflation is the easiest way for governments to rob the people, and that was right. Sustained inflation that changes behavior is a very bad thing, but it's not clear to me that 2.5 would do that. 3.5, yeah, I'd be nervous about that. But the 2 target maybe is just asking a bit too much to maintain in the medium term. We're in a different world from when those targets were set.
Yep. Well, that's what the symposium, I think, is all about, structural shifts, right? Dr. Shepardson, thank you so much for joining us. Really appreciate your commentary. Ian Shepardson there of Pantheon Macroeconomics. Now, Tom, John, and Lisa will be live from Jackson Hole with a special edition of Bloomberg Surveillance starting at 8 a.m. Don't miss that show with Jay Powell's speech, plus the Peterson Institute's Adam Posen, Kristalina Georgieva from the IMF, Philadelphia Fed President Patrick Harker, and insight from Bloomberg opinion columnist Mohammed El-Arian. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
If there was ever a soft landing, taking 6 percentage points off the headline inflation rate without an increase in unemployment would sound like a soft landing to me.
That was Jim Bullard, former St. Louis Fed president, speaking with Bloomberg's Mike McKee yesterday. Mike was in Jackson Hole. Bullard was at Purdue, where he is now the dean of the business school. Really interesting conversation, and he brought up maybe a new inflation regime as well, which we're going to talk about in just a moment with Cameron Kreis. Right now, I want to take a look at the markets and where we are. Just about 3 hours, a little less than, ahead of the market open. But you can bet there's going to be very low volume and traders kind of sitting on their hands until we get through that Jerome Powell speech at Jackson Hole. Right now, S&P futures pointing up about 0.3%. You've got the euro a little weaker against the dollar, as is the pound, but not a big move right now. Still at 108 on the euro dollar. 10-year yields creeping very slowly higher, holding at about 4.25, where we finished the day yesterday. And NYMEX crude also kind of holding a level at $80 a barrel. We see Brent at just under 85. So I think wait and see is what we're doing right now. Let me bring in Bloomberg's Cameron Kreis to talk about what to expect from Jackson Hole. And Cameron, you know, I was reading a lot of your work last night, fascinating stuff, and it reminded me of an interview that Tom Keene had done with Claudia Sahm a couple of days ago, where she said to her the most important or most interesting thing would be a discussion about a change in R-star, which I thought was already like an ephemeral, abstract, idea anyway. But is it the case that everyone kind of agrees what it is now and that we're going to raise that forecast today?
Yes, it is ephemeral, but when did that ever stop academic or policy economists from talking about it? I would say no, it's not the case that everybody agrees what it is. Certainly, the FOMC seems to think that it's still 0.5%, given that that's the dot plot median and has been for some time, although the distribution of those dots have moved up somewhat. A couple of weeks ago, the New York Fed staff released a paper suggesting that looking at a couple of different models, one of which had R star, I think, up to like 1.8%. And again, this is the neutral real after inflation level, the policy rate. Another of their models had it at 0.7%. So it's kind of like a carnival barker. Pick a card, any card. Pick an R star, any R star. What I think it's fair to say though is that the 0.5% implicit in the Fed's dot plot looks awfully low compared to what those New York Fed models suggested, and also what we've seen empirically in the economy. If the neutral nominal rate really were 2.5%, or the real, we would have expected the economy to perform much, much worse than it has done over the last year and a half as the Fed has put rates up so aggressively. And the fact that it hasn't, I think, is a testament to the fact that something has changed. And, to quote the title of the symposium, that maybe there has been a structural shift away from the sort of post-GFC regime of very low inflation, very low nominal growth, and very low neutral interest rates.
Yeah, I ever since I was a kid, I've been obsessed with this neutral real rate of inflation, mainly because on the Bloomberg terminal, Damien, if you type in TAYL go, you get the Taylor rule. So you can see where, John Taylor's rules estimate that the rate should be the Fed's benchmark rate, and you have to plug in your own variables, right? So you can plug in what your own NARU is, which I've always also found really interesting, and your own neutral real rate. I've always used 2%, but apparently now I think consensus is more like 2.5%, and if that moves up, it's going to change everything. Right now, my Taylor rule estimate shows that we should be at 7.65%.
Well, that's if you listen to Ian Shepperson, 2.5%. I think, look, it only makes sense that we should be talking about the Fed ahead of Jackson Hole here. For me, there's a lot of other central banks that carry a lot of great meaning, and we have Powell at 10, but we also have Christine Lagarde at 3 p.m. So for me, Cameron, I wonder if you could tell us
4 p.m.
Is it 4 p.m. Eastern
time?
Sorry, he's right. That's my bad. But 4 p.m. Eastern time, and given the Euro PMI data that came out, Cameron, and all that's going on in the world, I wonder, does that carry a little bit more weight for markets than Chair Powell at 10? I wonder what your opinion is on that.
Well, no, if not, for the simple reason that the U.S. is still the world's biggest economy. The Fed's still the world's most important financial institution, and very prosaically, markets are shut when Lagarde's speech will hit the tape, and obviously they're wide open when Mr. Powell's does. Clearly, Europe is at something of an inflection point insofar as they put rates up much more aggressively than anyone would have thought possible a year and a half ago. And unlike the U.S., the impact seems to be feeding through more vigorously. As you alluded to, the PMI data was pretty execrable a couple of days ago. That being said, inflation remains more elevated than it does in the U.S. So that's kind of an unfriendly trade-off that the ECB is having to confront. They will need to sacrifice more growth to get inflation back down to target. We've had some of the usual leaks this morning from ECB sources suggesting that the arguments are building for a pause, but that nothing is decided yet. Which, that and $5, I guess, will get you a cup of coffee these days, or €4 or €5 or however much it costs in Berlin or Frankfurt.
So Cam, for me, I guess the question is, in your opinion, what's the biggest pain trade for markets? We saw when U.S. long yields, 10s and 30s started to spike higher. We felt the pain there. Is it U.S. Treasuries? Is it the dollar? Is it the Japanese yen? I'm curious to hear your thoughts on that.
Well, I guess the rejoinder question is, are we talking about sort of short-term traders, or are we talking about investors?
Yes.
Right? Because investors tend to have long-only portfolios. So obviously the biggest pain trade in that regard is asset prices continuing to fall. The equity rally this year, I think, took a lot of people, including myself, by surprise, not only in terms of how it shot out of the gate, but the magnitude that of what we've seen. So I think at this point, given sort of tactical investor positioning, probably the biggest pain trade out there would be technology going back to where it was 12 months ago. And I think the reaction to yesterday's NVIDIA earnings, which were clearly very, very good.
Sure.
And the guidance was clearly very, very good. And yet the stock opened up a lot and closed more or less unchanged. I was just looking, I think the 500 calls expiring today, they opened at, I don't know, $15 or something, and they closed at 26 cents. That's pretty painful. So I would suggest that the pain trade is that everyone who's been buying these short-dated options to drive the market higher suddenly finds that money starts turning worthless. And as interest rates continue to adjust higher, then we find that this entire equity market rally this year turns out to be something of a head fake. Will that be the case? Quite possibly not, but certainly that would hurt a lot of people, I think.
Looking at the Starbucks in Berlin, Cameron, right on the Brandenburg Gate, looks like a venti latte, which is my go-to, is €5.30 right now. But
I can't drink that stuff, man.
Well, I mean, if you're just looking for a filter coffee and you want to go with a grande, then you can get it for $3.19, which is pretty good.
Okay, yeah, that's my jam. Okay, $3.19, that's not too bad.
Cameron Kreis, great having you on the program. Thanks so much for joining us. You can read his Macro Man column on the Bloomberg terminal, or check it out if you go to the website, Bloomberg.com. Fascinating stuff. Gets pretty wonky. Cameron gets pretty wonky.
No, I would have taken him as a strawberry acai refresher kind of guy, but that's or maybe a Kai latte, iced something or other. But Cam's great. Look, interesting that he says the pain trade, and he's right. The market value that's been made in U.S. equities, that makes sense. If that reverses in on itself, I guess there's going to be a lot of money lost.
All right, coming up next, we're going to talk to Dana Dioria. She joins us from Envestnet. Get her view on what to expect out of Jay Powell and Christine Lagarde at Jackson Hole. The main event with Tom, John, and Lisa starts in 1 hour at 8 a.m. This is Bloomberg.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
I've had the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup. Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What's been supporting equities, despite the higher rates that we're seeing, is actually the earnings.
A lot of people, a lot of companies are not feeling the pain of these higher interest rates.
I still think the probability of a recession is quite high.
I actually think we're on the cusp of a seminal change in Fed approach to targeting inflation.
Jackson Hole, if you're a bond investor, is the kind of main event this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning from New York City. For our audience worldwide, this is Bloomberg Surveillance. Alongside Damian Sassower, I'm Matt Miller. We're filling in because Tom, John, and Lisa are in Jackson Hole. But don't fret, they'll be along in just about 60 minutes' time. We've got special coverage with the OG surveillance team starting at 8 a.m., and that'll go through Jay Powell's speech into the afternoon. In fact, Tom has an exclusive interview at 4 p.m. With Christine Lagarde of the ECB. So a lot to cover today, and a lot I guess I was going to say a lot going on in markets, but actually that's not true. There's not much at all going on in markets right now because I think people are waiting, right?
Yeah, absolutely. And I think, look, if you just look at how great a quarter it's been economically speaking in the U.S., I mean, we're tracking at, I think, 4% growth here in the third quarter. I think the Atlanta Fed is at 5.8%. And again,
5.8%, yeah.
5.8%, and unemployment's at what? 3.5%. Go figure.
Yeah, New York Fed at 3.8%. So there's a big delta there, but it's still better than a stick in the eye, no matter how you look at it. Dana Dioria joins us right now, co-chief investment officer over at Investnet, to give us her take on, I guess, first of all, Dana, what's most important to hear from Jerome Powell at Jackson Hole? It seems to me already to have told us, like, September's a live meeting. We still need to nip inflation in the bud. We're not done with that. And we're not going to cut rates for years. So
That's right.
What's new?
Well, I think that may be why you're not seeing much movement in markets. I think pretty much what Chair Powell is going to tell us has already been priced in. I don't expect any surprises from him today, right? I mean, he is completely empowered. If you look at the minutes, FOMC minutes from July, they were already striking kind of a hawkish tone. Inflation has come down since then, but at the same time, most economic indicators have come in pretty good. GDP blowout, basically, compared with what was anticipated. As you're discussing, growth looks fantastic right now. So no recession yet. I think Chair Powell is pretty empowered to just continue with the tone that he's had all along, which is to say, look, I'm going to look at the data. I'm not going to tell you that we're done. Notwithstanding some of the other comments that we heard yesterday.
Is the growth that we're looking at right now concerning, because that means inflation could be reinvigorated? Is this boom going to be a problem, leading to more rate hikes, leading to a bust?
Yeah, it could. I mean, you don't want to say growth is a bad thing, right? I mean, it's fantastic that the economy has been so resilient. Who would have predicted? If you look at it, beginning of this year, pretty much every pundit was saying, expect a recession in the second half. And it's not that I, practically speaking, think that we're past that necessarily. To a certain extent, that could just be pushed out a bit. But the resilience of the economy has been fantastic. It does, of course, mean that the Fed, whose mandate is inflation and unemployment, just may want to hold on longer, right? And exactly what they've said, whether we get a rate increase in September or not. Expectations of rate decreases are just probably too early. I mean, unemployment remains low. The economy is doing well, and the Fed knows that inflation tends to come in waves, right? That kind of looks good, but we know what's happening in wages. We know what's happening in energy. These are signs that inflation could come back. And there's no reason to think that the Fed is not going to want to have a firm hand on inflation. So I think it's entirely possible we get another hike.
Dana, I agree with you. I agree with everything you're saying. The economy is healthy, and the markets have really priced in much of the same, right, as it relates to Chair Powell and Jackson Hole. But to deliver that message, to deliver the message that we are going to pause in the face of economic growth, again, third quarter running at 4% with unemployment at 3.5%. The messaging, how are you going to thread that weave? How does Powell thread that weave? And are the markets prepared if he messes up the end game?
I think he's got the wind at his back. I hear you on this. And yes, the messaging, I actually think Christine Lagarde has a more difficult, thread or needle the threads, so to speak. But I think Chair Powell can stay pretty hawkish, and the market is not going to get surprised by that. Well, I mean, he's been, right? We saw the minutes, and it's been clear sailing since the last, the FOMC minutes. So I think the market fully expects a somewhat hawkish tone from him. I think he'd have to go pretty far to, kind of upset the market at this point. And he may well, given some of the comments that we've heard, he may well talk about, hey, look, we could have a pause, right? I mean, even a little bit of dovishness from him, I think, the market might actually greet very well. I think the market expects him to signal that he's going to retain a firm hand, that we're not going to blink in the face of, potential increases in inflation. I mean, the good news, of course, is that inflation really acted symmetrically, right? It went up very fast, but it came down very fast as well. So, I think he's got tailwinds here for today.
Dana, I love that you mentioned Christine Lagarde. You know, I wonder if you could just build on that for us. You know, what are the challenges that she faces in communicating her message?
Yeah, I mean, she's got to, I think it's tougher for her because, of course, the economy there is not showing as much resilience, looking like it's slowing down. Definitely, you know, I spoke about the fact that some economists think the U.S. economy is soft landing. Some, I get a lot of information from a lot of different sources. Some are definitely just pushing out the forecast and saying, no, we're going to probably have a recession, but it's just going to come a little later. I think Eurozone, just more of the statements are expect a recession. Obviously, growth is slowing there. PMI data that has come out, business survey data. So, but she still has an inflation problem to a certain extent, right? Or at least to the extent we do. So, does she do another hike before it becomes evident that it's really difficult for her to do another hike, right? Because before economics, kind of force her hand to stop on the hike. So I do think she has a tougher message. That narrative that you're talking about, I think is tougher on her than him.
If we look at the markets, Dana, as you do, right, at InvestNet, what are you doing? We ran up to 4,500 on the S&P in an AI kind of frenzy. It seems that, the market feels like all of the good, at least for NVIDIA and the rest is priced in, the rest of the Magnificent Seven. So what do we do going forward if we are worried about the possibility of another hike and not optimistic about any cuts coming anytime soon down the line?
Yeah, I think it calls for some caution, right? I mean, we cater to advisors of retail investors, and I do a lot of talks, along these lines, economic talks, and whether you want to predict that there's a recession, in which case probably obviously market volatility is still more to come, or, you think there's a soft landing, maybe slow growth, whatever that is. I think, as investors, we're behooved to have some caution going forward. I think there's more risk to the downside in this market because, to your point, right? I mean, AI kind of comes in, but I think we all know AI may be, a huge boon to the economy. It may increase productivity dramatically, but that's not going to happen overnight, right? We're not there where we're going to see some great AI-driven productivity gains in the next 6 months to a year. So, the AI that's been priced in, now it's kind of a waiting game on that, whether that's going to, amount to anything that actually impacts cash flows, that impacts revenues. So, yeah, you've got this priced in great outcome. Multiples are higher. Really, the returns from this year are largely multiple driven, right? And then you have these downside risks to the economy still. I mean, we're not past, we are seeing great data come in on GDP, earnings, obviously beat, but we're not kind of past, we all know just from history looking at it, monetary policy acts with a lag, and it's not uncommon for unemployment to be pretty low before problems in the economy start to fester. So it's not a prediction, but it's more, if you're an investor, kind of battening down the hatches and being ready for market turmoil is probably the smarter place to be.
Long and variable lags. Dana, you take what the market gives you, and one thing the market is giving us today are positive real yields. I'm talking 10-year real yields here in the U.S. of about 200 basis points. What are your thoughts on that? I mean, usually that's a negative for risky assets. I'm curious to hear your thoughts this time around.
Yeah, well, and also the dollar, right? Those are signs too that the markets are saying maybe there's trouble ahead. And don't get me wrong, it's not by any means my message that you should get out of equity markets. I'm actually, again, we work with advisors, and the job of the advisor, one of the main jobs is to keep the client disciplined in the market, so they're not obviously selling out at the wrong time. I think it's a question of your posture in the market. It's not a matter of get out of the market, because you could well miss some great additional upside and you're not going to make that back. You're not going to time it right coming back in. But, in the market, most retail investors, if they're not flat out, market weighted, they're in some sort of a actively managed portfolio that's probably low tracking error, right? We don't, I won't say closet index, but low tracking error to be expected. And if you're anywhere near market cap weight, you have a ton of these technology, growth, communication, right? The enormous 8, magnificent 7, as you said, you automatically are going to have that just by being in market weight or close to market weight, which most of these investments are. So, what I would say to people is, to posture a little bit more defensively. Rates are telling us that, there's potential turmoil, and the bond market is a pretty good as indicators go, right? It's a decent indicator. So, quality type companies, even low volatility, right? These types of style factors where you can tilt a little bit. Again, not that you're taking on massive tracking error, but to the extent that you're tilting away from market cap weight, that's the direction I would be going in.
All right, Dana, thanks so much for joining us. Dana Dioria there of InvestNet talking about what she would do in markets. She points out that the bond market is a great indicator, and I go back to Cameron Kreis's Macro Man piece from, I think it was like 2 days ago. He has a great chart of the 10-year annualized growth in nominal GDP and the 10-year yields, and they track so well. Yeah. And now that we're starting to see yields tick up, you got to think nominal growth is going to go with it.
Well, I think it's that evisceration of the equity risk premium, right? I mean, the fact that, look, your risk-free rate now on a real basis, an inflation-adjusted basis here in the U.S. is more than the dividend yield or the equity yield you're going to find on stocks. I mean, you don't see that very often.
No, very interesting stuff. Let's take a look at what's going on in the markets. Right now, we've just got about 2 hours and 15 minutes until the market opens, but more like 3 hours until Jay Powell starts to talk. So you do have S&P futures up after a big drop, more than 1% yesterday. Futures gaining about 0.25%. Euro dollar unchanged there at 108.08. Which maybe that's good luck. The 10-year yield also unchanged, hanging right around 425 after bouncing back a little bit yesterday from under 420. And NYMEX crude just under $80 a barrel at 79.85. Brent crude, the global benchmark, is under $85 a barrel. So as I said, Tom, John, and Lisa are going to be here live. Well, not here. They're going to be there live from Jackson Hole with a special edition of Bloomberg Surveillance that starts at 8 a.m. and it's a show you don't want to miss because Jay Powell's speech will happen, I believe, 10:05 a.m. We're waiting for a 10:05 a.m. start for Jay Powell. Plus, on the program, we've got Adam Posen from the Peterson Institute, the IMF's Kristalina Georgieva will join us. Philadelphia Fed President Patrick Harker is on the show, and a friend of the program, Bloomberg opinion columnist and Queens College Cambridge president Mohamed El-Arian will be on the program as well. Then later today, you don't want to miss Tom Keen's exclusive interview with ECB President Christine Lagarde. That again, live from Jackson Hole on Bloomberg Television at 4 p.m. Eastern. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Today, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Tune in for continuing coverage with a special edition of Bloomberg Surveillance live from Jackson Hole starting at 8 a.m. Eastern. Bloomberg, your global business authority.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
Former President Donald Trump there speaking after turning himself in at Fulton County Jail. He got a mugshot. I'm not sure if he got fingerprints.
He must have.
I think, yeah, that was procedure. So maybe he had to get printed.
I mean, when I get arrested, they take my fingerprint.
Yeah, exactly.
All the time.
Same with me. Anne-Marie Hordern has never been arrested, I'm relatively sure. She is our Bloomberg Washington correspondent, joins us now out of the nation's capital. And we joke around about this. Obviously, it's very serious. A president of the United States has been arrested, essentially. He's been in jail, reportedly, for 20 minutes. He got his mugshot taken. We assume he got fingerprinted. And I guess this just goes and boosts his popularity with his base.
Well, it absolutely does. So it is an unprecedented moment in American history that you have a former president not just arrested. This is the fourth time he's been indicted. Showing up, he surrendered. As you say, Matt, a mugshot was taken. They recorded his weight and height, 6'3", 215 pounds. I cannot independently
215 pounds? I'm going to go ahead and call. No, that is not the case. I am 210. Is Donald Trump only 5 pounds heavier than me?
No comment.
Well, this is something that this is something that actually people are debating on Twitter. But in all seriousness, this is actually what happened in Fulton County, Georgia yesterday for about 20 or 30 minutes when the president showed up to surrender. He then went to the airport. He talked about how this was all a sham. And then within really minutes, you had his Super PAC campaign putting out fundraising alerts, and they're selling his mugshot on T-shirts for $34. So they are already monetizing this. And we do know that the Trump campaign does bring in a ton of money. And then he is using a lot of those funds from individuals that want to donate to his campaign to actually pay for these legal fees. And these legal challenges are just continue to pile up, and this being the latest.
All right, so this just, I think, supports his base, but maybe not Republicans who are on. By the way, I think it's a great mugshot. Not that it matters, but it's like a cool look. It doesn't matter to those who are looking for something else, right? And that's what the debate was all about. And I thought you had a fantastic interview yesterday with Nikki Haley. I thought a lot of her answers on issues were surprisingly different from the answers you would have gotten from Trump in terms of the spending, government spending. She criticized both sides of the aisle. In terms of abortion, she said while she's pro-life, she believes it's a woman's right to choose what she wants to do with her own body in terms of health care. So didn't you find that surprising as well?
Well, a lot of things that Nikki Haley said on the debate stage and also in our interview is really tailored as well to how a candidate on the Republican side would need to pivot in terms of a general election to gain independent voters. And you look at some of the stats following the debate and who won, Washington Post, Ipsos, they did at 538, they did a poll, and what they found is that DeSantis actually topped the stage, then Vivek Ramaswamy, and then Nikki Haley. When it comes to independence, Nikki Haley, the former UN ambassador, the former South Carolina governor, did very well. And it's issues like this, like abortion, that we've seen really dominate dominate when it comes to moderates and independents and whether or not they want to go out and vote and who they're going to vote for. What you had on stage is a lot of individuals that want to talk about a 6-week ban, a 15-week ban. She said to the American people, we should be honest about the fact that there can never be a national ban because we just don't have the votes in the Senate. So she was trying to find some sort of consensus on an item like abortion. And then when it came to the economy, she didn't just throw the Biden administration out the window when it comes to spending. She also criticized the Trump administration, which, by the way, she worked for. She said $8 trillion was added to the federal debt under Trump. And she also talked about individuals on stage who voted in Congress to add to that debt. Ron DeSantis, Mike Pence. So she really took aim at everyone, and this would be how an individual from the Republican Party would have to start to pivot in a general election to pick up those independent moderate votes.
Anne-Marie, let's get serious for a second here. Interest payments on $1.6 trillion in student loans begins reaccruing on the 1st of September, right? A group of 90 Democrats, including Schumer and Warren, are petitioning Biden to do something about it. I'm curious, at this stage, is there anything Biden can do to stop the September 1st deadline? And more importantly, what's the risk of doing nothing?
Well, the December 1st deadline is around the corner. I think what the Biden camp probably wants to do is say we gave it our best shot. The Supreme Court, of course, recently struck down what their plan was to help individuals with student loan debt, about, I believe it was up to $20K per person. And they can campaign on, we will continue to try. It does seem like it is too last minute as these repayments are going to be due. They have been frozen, remember, since the Trump administration. Trump, during the COVID economic hit, a lot of individuals were facing, froze the student loan payments. But I should note, it's not just coming up here in Washington. On a lot of analyst calls for businesses, it is coming up. Levi's, Target, they're concerned that a lot of discretionary spending that individuals had because they haven't had to pay things like student loans, that's going to start to bite in the fall.
Mortgage debt is due as well.
Yeah.
I have interest payments on my mortgage. Do you think they can cancel that? Can we just cancel all debt?
I'll have Tom make
Don't
some
you,
calls.
when you agree to a loan, don't you then have to pay it back? I don't understand why we're trying to wiggle out of this.
Well, I'll tell you this, the reality is, and Anne-Marie, I wonder if you could just help me with this one last thing. I have to put my emerging markets hat on for this. Sanctions on Venezuela, right? Removing sanctions for free and fair elections in Venezuela, the Maduro, come on, is that real or is that just trying to bring oil back online?
Well, I think it's probably twofold, right? The sanctions in Venezuela has absolutely crippled their oil market. You have concerns about potentially how gas prices may react going into an election year. But this is about if there was actual free and fair elections. We have seen Maduro in the past not allow free and fair elections. He's coerced individuals. So he would have to make massive concessions in terms of an election in order for any sanction relief. We should just say Bloomberg is just reporting that there are talks about this. We are not there yet.
All right. Anne-Marie Horton, thanks very much talking to us from Washington, D.C., our chief Washington correspondent on the Trump arrest and what we can expect from the Biden administration. A total of $17.1 trillion in mortgage debt.
Oh, wow.
I mean, if you want to start just wiping away debt.
Well, look, the 1.4 sounds like a much more manageable number, right? We just expand the Fed's balance sheet, we go right back at it. But look, what's most interesting is how disinflationary the impact of those payments coming back online very well may be. So everyone's talking about upping the inflation target. I'm concerned inflation may come down even faster once these student loan payments start come back online. I don't know if the market's fully prepared for that.
But we want disinflationary.
Yeah,
we're trying to get rid of inflation.
Sure,
right?
we want a hard landing, right? We want a recession. I don't know if we want that, but that's kind of.
I think we want inflation to come back down to 2%, right? That's the generally accepted level, and we're pretty far away from that still. If you look at the core PCE, it's more than double that. And that's what the Fed targets.
That data comes out next week. We'll see what happens there. But let's see what happens once these student loan payments come back. I'm skeptical.
All right. Well, we probably will see it because the Supreme Court didn't let him cancel those. Take a look at what's going on in the markets right now. We don't have much happening in futures right now, up 0.25%. You did have a drop yesterday of 1.5% on the S&P, almost 2% on the NASDAQ. So gaining back a little bit of that, it looks like, but we're all waiting for Jerome Powell at Jackson Hole. You can see the euro dollar at 108, the 10-year yield at 425, and crude trading at $80 a barrel. Don't miss later on today Tom Keen's interview with ECB President Christine Lagarde, live from Jackson Hole. As Damien points out, she'll be giving a speech at 3 o'clock. We'll probably take that live as well. And then our exclusive interview with ECB President Christine Lagarde. That's at 4 p.m. on radio and television. Coming up, Tom Tesouras, head of fixed income at Strategas, a Baird company. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
This is Bloomberg Surveillance. I'm Matt Miller alongside Damian Sassower. Tom, John, and Lisa will be along in just about 30 minutes' time. They've got a live special from Jackson Hole. It's a show you don't want to miss, obviously. We're going to get the speech from Jay Powell. The markets may start actually moving at that point. And then later on, Christine Lagarde will speak, and Tom Keene has an exclusive interview with the ECB president. So very much looking forward to all of that today. Let's take a look at what's going on in the markets right now. They're relatively stayed after the big drops that we saw yesterday. Frankly, pretty amazing drops considering the fact that NVIDIA had such a massive beat and we thought so much was riding on it. It finished the day unchanged. The S&P was down 1.5% and the NASDAQ was down almost 2%. So a little bit of a bounce on S&P futures, up about 0.25% right now. No change in euro dollar, no change in 10-year yields, and NYMEX crude actually coming up $1.06 to $80.11. Under surveillance this morning, investors awaiting Fed Chair Jerome Powell's speech from Jackson Hole. We're going to be looking for clues on the central bank's outlook, the economic outlook, obviously. That's at 10:05 Eastern, Jay Powell's speech at 10:05 Eastern in Wyoming. Later today, as I said, Tom has an exclusive interview with Christine Lagarde. That is at 4 p.m. Eastern, which is an hour after her speech. So she'll give a speech at 3, but the cool thing will be her interview.
Of course.
Because not only is that exclusive,
it's Tom Keene.
It's Tom Keene, also must-watch viewing. But, you know, he gets to actually ask questions. Yeah. So it's not just the speech she delivers, but he'll get to dig into that. And I'm very much looking forward to it.
He's very prepared in the line of questioning that he typically asks, which we all know.
Yeah, well, it's definitely good television. And Damian Sassower here with me to fill in while Tom, John, and Lisa prep for the special. Let's talk about something that Damian knows very much about: China unveiling new mortgage policies aimed at halting a slump in its residential property market. The rules include more support for home buyers as they look to revive the world's second largest economy. And I say you are well versed in this because emerging markets is your wheelhouse. It's your specialty for BI. What do you think about this?
Matt, thanks for pointing that out. I am the chief emerging market fixed income strategist for BI in my day job. But, you know, for me, China's going to be all about growth. It's going to be all about the PMI data, which comes out next Thursday, which is going to be weak. And really the fact that they just can't get the consumer moving in the right direction domestically. I mean, households are in trouble. They're highly geared toward the property sector, which is in a funk. Just today, we're going to find out if Country Garden, once the nation's largest private property developer, is able to come to terms with its creditors, right? And the verdict is still out, but it doesn't look likely given Evergrande and some of those who have passed before it. Waiting to see that by the end of today.
Well, something that is key to markets, and we're going to continue to read your excellent research, BI Go, to find Bloomberg intelligence. I want to talk about something frankly near and dear to my heart. Watches of Switzerland plunging after Rolex revealed that they've bought fine jewelry seller Bucherer. The relationship between Watches of Switzerland and Rolex in a way is in question, given that the world's largest luxury watchmaker is now going to own its own stores. And this is key because Rolex has always said it'll be independent of retailers. That's why it's had such a good relationship with its authorized dealers, and this puts that relationship in question. Will it favor its own stores?
But hold on, Rolex does have one store in its home city of Geneva. So, you know, it's not like the whole retail. No, I'm kidding. It's going to be all new to them. I mean, getting their Daytonas, their GMTs, their Submariners out through a chain of what I think it's 100 stores at Watches of Switzerland. It's going to be interesting to see how things shake out.
Yeah, I'm going to be following this one very closely because we still have, you know, used Rolexes are still going for more than new Rolexes, because if you want a new one, you have to get in line, you have to know an authorized dealer, and you have to wait for months to get it. Tom Tesouris, head of fixed income research at Strategas, joins us right now. Strategas is a Baird company, and we're happy to have him here with us, especially on such an important day for fixed income. Tom, what are you expecting? What are you watching for, listening for from Jay Powell?
Well, I don't envy Jerome Powell today, because no matter what he does, the market's going to move. If he comes out and suggests that there's more work to be done, which is what I think he's going to suggest, then you're going to see very likely the front end of the Treasury curve moves higher, the dollar rallies, risk assets wobble in particular, banks in particular discretionary spending sectors. If he comes out and somehow suggests that we're coming to an end of the tightening cycle and we see a light at the end of the tunnel, then pretty much everything except the US dollar is probably going to rip higher. And that's a problem in and of itself, because that means easing financial conditions when it's very clear to us that we're not getting close to the end of the tunnel. We're at a point where inflation is getting sticky and could very easily reaccelerate, especially when you see crude moving higher and you see wages continuing to remain 4.5% to 5%. So no matter what he does, the market's going to move. But my hunch says he's going to side towards the hawkish side here and say that we have more work to be done, which we all know for the most part, but he's going to leave it open-ended what that means. And in particular, what that means is rate hikes could happen. They're probably done, but there could be more. But balance sheet reduction is going to continue indefinitely.
Yeah, I'm watching the wages picture also very closely because, well, Damo's worried about student loans coming back, but we've seen unions gain a lot of ground, starting with Deere, and we recently saw UPS, right? Those drivers are getting $170,000 a year if you include benefits, and now the UAW is going to renegotiate contracts with GM and others, and that's going to be absolutely fascinating. Where do you see the 10-year yield in this case? I mean, we're up above 430 at the beginning of the week. The highest level since 2007, which I thought was absolutely fascinating, higher than the great financial crisis. And we heard, actually, Larry Summers told our David Weston a couple weeks ago that he thinks 475 is going to be the decade average that going forward. I mean, that's pretty high.
Yeah, so let me put it this way. I am very surprised the 10-year hit a new high, cycle high this year. Not because I don't believe the fundamentals support it, but because I believed, and I still believe, that we're going to have a reversal lower, a recession before we hit that next cycle high in the next cycle. But with that said, the second wave of inflation has already started. As you mentioned, we've got wages rising and we've got wage inertia in the pipeline for years to come. So that tells us that the second wave of inflation is just, 6 months to 24 months away at most. So eventually 10s should go up to those levels that Larry Summers is speaking about, a 4.75 to 5%. That would be consistent with nominal growth somewhere around 5%, 10s around that level. But the question is, do we have a recession before we get there? That's the real question mark. And that's not an easy question to answer, because that comes down to, when does the consumer pull back? Does the consumer pull back and stop spending spontaneously, or do we have to see credit cracks emerge to force the consumer to pull back? If you assume the consumer is not going to pull back, then absolutely it's higher on the 10-year yield until we hit that recession. And somewhere around 4.75 to 5, very reasonable in my opinion.
So sans a recession, 4.75 to 5% on 10 years, let's say by 2025, right?
Yep.
Is that going to be driven by break-evens or real yields?
Both. So break-evens logically need to move higher, and let's just focus on 10-year break-evens. So somewhere around a 3% seems to be a logical level, because 1, that's where inflation is getting sticky. 2, wages are getting sticky above 3%. And there's a very good chance that in the next 2 to 3 years, the Fed pivots towards a 2 to 3% inflation target. So we got break-evens around 240 or so on 10. So a 50 basis point rise in break-evens, very reasonable. It's not a huge move, but that gets you up to 475. But with the move in break-evens, real yields need to probably rise a little bit. If not, then monetary policy is loose and you could have an even bigger move in inflation. So both.
So in that environment, tell me which fixed income asset classes are best positioned to be successful? Is it going to be MBS? Is it going to be munis? Talk to us about that.
Well, very likely the front end of the curve, short duration investment grade corporates, and that's not a particularly exotic call.
Yeah.
That's pretty much a safe haven for most investors, but that very likely outperforms in the short run, especially if the Fed only gets a few rate cuts in along the way. So the Fed funds rate only comes down to, let's say, 3.5% to 4%, because then it's not much of a move from 4% to, say, a 6% Fed funds rate. In contrast, let's say we have a recession, 10-year yields drop down to 350, and then we go back up to 5%. You're talking about a dozen percent to 15% loss in 10s. So at some point in time, we're going to have another round of bond pain.
Duration losses.
Yeah, exactly.
And probably spread widening off the back of that, one would think.
Very likely. So a steeper credit spread curve as well. So the question, again, becomes, if you're long duration, you must be expecting a recession to come before we hit that second wave of inflation. And very likely, I do believe that recession is going to come, but that's really what you're expecting if you're long duration.
You know what?
now.
That recession comes, and yesterday we were talking to Michael Darden from MKM. He said he thinks junk is insanely expensive. Those were his words. Insanely expensive. If we start to see defaults at a higher rate, isn't that likely, especially if the consumer is delinquent on loans and the student debt payments come back? I mean, isn't it likely that more companies are going to default, especially in the junk sector?
Very likely. We have gone through the last 2 credit cycles where outside of the bank space, you really have not had a clearing of the rot in the junk space. And so you've seen average defaults around 2 to 3%, when typically they're average 4%. So at some point in time, we're going to have a decade plus of 4.5% to 5% on average default rates. Let's say you got a 5% default rate, then high yield spreads at say 380 or so are way too rich right now. If you have 3% default rate, which is slightly higher than we've averaged over the last decade, then high yield's not too rich. But I do think we're going to move back to about a 4.5% to 5% average default rate. High yield will prove to be too rich. But important thing about high yield and investment grade credit right now is that we are not seeing a need to refi any of those maturities, because much of that maturity wall is 2025 for high yield, more like end of 2024 and into 2025. So we're still earliest 6 to 9 months away from a big pickup in refinancings. When the new supply hits, that's when you see spreads widen, and that's when you start to see public credit begin to move into a space that's really not sustainable from a cash flow standpoint. We're not there yet, but we will be.
I love that you're focusing on supply here. We had that 30-year auction last week. We saw the 30-year tips tail yesterday. We saw the 2-year floating rate note. It wasn't so great. Talk to us about the plumbing of financial markets, specifically U.S. Treasuries. Talk to us about the TGA, the RRP. Does any of that give you cause for concern?
Oh, absolutely. And let's put this is a great backdrop.
By the way, the TGA is the Treasury General Account.
That's correct. Sorry.
The RRP is the reverse repos.
Thank you, Matthew.
Well, but my mom watches. People. Not everybody knows all this jargon.
That's right. So it seems insane to me that right now the Treasury is finding that it can't come to market without having to pay up, but we're expecting corporations to indefinitely not have to pay up. The Treasury is giving us a look at what's to come in the future. That is, the supply is no longer going to be very easily digested, whether you're a Treasury or a CCC. So what's happening here is you're seeing Treasury supply now entering the coupon stack. It's no longer T-bills. And now go to your question about the TGA versus the reverse repo facility. When the Treasury was blasting T-bills into the market from June to August, much of that, not all of it, but much of it was coming out of the reverse repo facility. So it was essentially sterilized liquidity buying new sterilized issuance. That is changing because the Treasury cannot continue to finance itself at 5.5% when it's got a 4.25% on 10s. That's not a logical strategy for the taxpayer. So they have to increase their coupon auctions. So we're starting to see that. And the market is saying once you open the floodgates on rising coupon auctions, there's more to come, and you're going to have a bigger and bigger concession. So again, the question is, do you have a recession before the supply jumps another leg? If not, then you're just going to continue to see the concession build in Treasury yields.
Until something snaps.
Until something breaks.
And the crowding out effect.
Yep.
Tom, great having you in the studio today. Thank you so much for joining us. Tom Sisouris there of Strategas. Say hi to Jason and Chris and Dan for us. Great group of guys there at Strategas. We're looking at futures that are rising, but not substantially, just about 0.25%, and really little change in a number of other assets, except for oil, which is up 1.33%. Coming up at 8:30 a.m., Neela Richardson, chief economist at ADP, will join Tom, John, and Lisa in the Jackson Hole special. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways,
this convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
This reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy.
Former St. Louis Fed President Jim Bullard speaking to Bloomberg's Mike McKee yesterday, kicking off our Jackson Hole coverage. Of course, in just about 15 minutes, Tom, John, and Lisa will be along with special coverage throughout the morning. Take a quick look at what's going on in markets. Right now, nothing. Futures, after the big drops we had in the cash trade yesterday, up about 0.25%. The euro stuck at 108. The 10-year yield unchanged at 424, 425. We do have a little bit of movement in crude, and it's been interesting to watch oil move around. Right now, it's back up over $80 a barrel. This is for NYMEX crude, and we do see the global benchmark Brent just under 85. So that's really one of the few assets that we see moving, because I think traders are waiting for Jay Powell's speech. That's at 10:05 a.m., so 35 minutes after the market opens, and maybe then you'll start to see some volume on this Friday. Joe Livornia, chief U.S. economist at SMBC Nikko Securities America, joins us. He is, of course, a former chief economist for the White House National Economic Council under Donald Trump. Joe, great to have you on the program this morning.
Thank you.
In terms of what the Fed is going to say today, you just heard Jim Bullard there talking about the reacceleration in the economy, and we've seen estimates from New York to Atlanta that are, growth of 3.8 to 5.8%, and that could, the concern is, stoke inflation, get those embers turning back into a fire. What are you looking at, and what are you thinking about the economy and the inflation right now?
Two things. Thank you for having me, Matt. Two things. Number one, if you look at past recessions, it's not unusual for there to be one last gasp in economic activity right before the economy rolls over. In fact, we've had it about two-thirds of the time where growth is over 3%, and the economy then goes into recession either that quarter or the quarter after. So GDP tells us nothing about where we're going. Those estimates right now are based on just a little bit of data we have for the third quarter, and it's going to change. That's number one. Where I push back against Jim's comments are, if you look at the good side of the economy, the New York Fed has a supply chain pressure index. If you look at import prices from China, both of those series suggest continued and ongoing deflation in goods. So the goods part of the economy is going to continue to soften, number one. And number two, if you look at the rents, the Cleveland Fed has a very nice new rental turnover index. It suggests rents are going to collapse. So this notion, Matt, that inflation is going to remain sticky, I don't understand where that's coming from. The inflation trends don't every month go lower per se, but the trends are definitely weaker. And if you look at the yield curve, the index leading indicators, where borrowing costs are for mortgages, autos, credit cards, personal loans, tightening and lending standards, all that suggests the consumer is going to be coming under significant duress.
So, Joe, to be clear, you are a cynic of the soft landing scenario, and I am happy to inform you, you are not alone. So talk to me about what a hard landing really might look like. Is it going to be something shallow or perhaps more sinister?
Recessions typically are nonlinear events, so something has to happen while you're kind of sort of in what initially oftentimes is a very mild recession. For example, in 2008, it was very mild. The services economy, looking at the ISM, was actually recovering through the spring. Many were saying that the economy had avoided a downturn. GDP grew almost 2.5% in the second quarter. Bear Stearns was saved by JP Morgan. Leading indicators were turning up. Then we had Lehman. So what would have been maybe the shallowest recession ever became a very deep recession. This time around, it will depend in part on what the Fed does. If the economy starts to weaken further, as I suggested it will, what will the Fed do? What will happen on the fiscal side? The politics next year will not be good for growth, given the uncertainty in the election outcome. That could cause a freezing in, say, business investment outside of, say, a couple of hot areas like AI or, say, ESG. So it will really, to sound like an economist, unfortunately, it will really depend on what happens as we enter it. We can't say, I don't think anybody can say at this point whether it's going to be hard or whether it will be soft. It will depend what the policy response is, what the regulatory response is when it begins.
So, Joe, I mean, you rightly point out that surge in real yields that markets witnessed back in 2001 and then again in 2008, right? So I guess, when I think of those years, my question for you is, do we think a major correction is nearly upon us here? I mean, and what might that look like?
The equity risk premium, if you take 3-month bills at yielding, 5.5%, suggests the equity premium is significantly negative.
Yeah.
And a correction could look something similar like what we saw back in 2001, where valuations are totally askew from what you could earn risk-free in the bond market. And if you look at the narrowness of the equity performance, it does suggest stocks are extremely overvalued. However, if the Fed becomes less hawkish, they start to lower interest rates, most of the rise in real rates has been due to expectations the Fed won't be as aggressive in cutting. It's not been a break-even story. Break-even inflation generally has been very contained. So if the Fed does cut rates and equities can grow into their valuations, I worry the Fed is going to keep rates too high for too long. There'll be some break in the system. It will become self-feeding and self-sustaining. The Fed won't move as quickly as it may be supposed to. That causes a deeper recession. And then you're looking at stocks, say, somewhere S&P around 3,100.
I want to ask about, Joe, your former boss and President Biden, both of them spending money like it grows on trees. I think President Biden put an extra, a $1.6 trillion deficit is what we're looking at this year. And President Trump spent, $8 trillion. Is there anyone who's going to call for some kind of fiscal responsibility, or are we all, modern monetary theorists now?
Yeah, I don't like the modern monetary theory at all. I think it's sort of there might be a valid point somewhere there, but and we saw when you spend Committee for a Responsible Budget, we said we had $6 trillion in COVID spending, and we spent almost all of it, and then the Fed did about another $7 trillion when they weighed it up. So when you have all that spending, you're going to get inflation, which is what's happened. There does not seem to be any desire in Washington right now to be more fiscally responsive. And unfortunately, I would argue the fact that the Fed's got this playbook of QE has given Washington, on both sides, the ability to spend, perhaps in the old days where that wasn't the case. Remember when Alan Greenspan said if Bush 41 raised taxes, we'd cut interest rates a little bit, and that's what happened. That is a relic of the past. So I think right now, while I clearly would argue that Mr. Trump's policies and Mr. Biden's policies are totally different, in aggregate, there doesn't seem to be any desire to have a good fiscal house.
So what does this mean for, Liz McCormick has a story out saying that just the interest cost, servicing the debt that we have is going to eventually eat up 20% of our tax revenues. When does this become a real problem? When do we see a debt bomb?
I don't think we see a debt bomb because the dollar is still the world's reserve currency. There really isn't anything at this point to replace it. That may change over the next few decades. We could finance ourselves. It'll depend on what the cost is. But Matt, one of those reasons those interest costs have risen so much is that we've had a record rise in interest rates. The Fed funds rate's up about 500 basis points, 525 basis points in the past 15 months, and that is what's driving interest costs. And the fact the yield curve is so massively inverted tells us that monetary policy is too tight. When the economy goes into recession, the Fed eases, that will help lower those interest costs, and then we see what happens thereafter.
Joe, great talking to you. It's been a long time. Hope we speak to you again soon. Joe Livornia there,
Thank you.
SMBC, Nikko Securities America, talking to us about what to expect from Jackson Hole and this U.S. economy. Taking a look at markets, we're not seeing a lot, and I think you're going to see very light volume at the open as well. Futures now about 0.2%, no change on the euro or the 10-year, and crude bouncing up just a little bit. But of course, you're going to expect, Damien, traders not to do anything serious until they hear what Powell says.
I'm thinking bacon, egg, and cheese. Well, I like egg whites personally. You know, maybe like an early lunch, right? You know, something
I
light.
eat the
you know,
whole
a
egg,
salad.
which is why I'm 210 pounds. But do I look as big as President Trump?
No.
Is he really
very svelte,
215?
very svelte.
I think they meant 250. Did they actually weigh him on a real scale?
Probably.
I do not believe that the former president is only 215 pounds. That just seems like made up, and I can't believe that they would do that at the Fulton County Jail in Georgia. Coming up next, a special edition of Bloomberg Surveillance begins. Adam Posen is going to join us from the Peterson Institute for International Economics. Tom, John, and Lisa are going to take you through the Powell speech to Christine Lagarde. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction where they invest if they invest for the right reasons, just keep at it.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Chair Powell is not going to wave the victory flag today.
I don't think he'll be inclined to say much about the short term and the outlook for the Fed funds rate.
Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024.
I really don't think Powell is going to come out and make some kind of declaration that the Fed is done tightening.
What's really important is less what we're going to hear from Chair Powell and more the price action in response.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 12 months on from the promise of pain from Chairman Powell. 12 months later, we're at the epicenter of soft landing hopes and dreams. TK, a few hours from now, Chairman Powell, take it to stage.
A few hours from now, and maybe more than a few minutes, the zeitgeist this morning. The Bears are up early trying to get a game on the speech, and the rumor is a longer speech this year.
Longer than 8 minutes.
Longer than 8 minutes, which is large.
Lisa, what a difference from 12 months ago. The worry of unemployment surging to get CPI back down to 2%. And here we are with unemployment almost exactly where it was 1 year ago.
Does he reject the pain narrative? That's what I want to understand. Does he say we don't need pain to get where we need to get? We can actually get in a soft landing. Well, but this is my question. If he sort of goes into this question of look at this, look at how we've really right-sized inflation, this could actually be exactly what we've never achieved before. I'm going to be more like Ellen Greenspan and less like Paul Volcker.
Well, he may be more like Ellen Greenspan. This is a really important point, and it goes to what a lot of the fancy math is maybe a new definition of what measured is. And maybe he'll address that within the speech, but I would suggest his major issue with Ueda in attendance, Broadbent in for Bailey, and Christine Lagarde in for attendance, Georgieva to join us later. All of these elites are saying one thing, say as little as possible, and that's really what I think.
Well, let's go through it, Tom, piece by piece, and what we've got lined up for throughout this morning. It's not just about Chairman Powell. It's not just about the Federal Reserve. Arguably, if you strip the United States out of the equation,
I strongly
the
agree.
rest of the world right now is in a very, very different predicament. Yeah. Slow down in Europe, slow down in China. They're struggling to respond to it. In the United States, we're talking about resilience and potentially 3% GDP growth this quarter. Germany right now, Tom, would kill for that.
This morning, the news out of Germany was stunning. I'm going to open my conversation with Lagarde on a speech she gave in April. The world has been turned upside down since April, and this is a different Jackson Hole, Lisa, than I think we saw 6 weeks ago.
I think it's notable that we're here with the backdrop of classic American Western glory, and it's such an international confab with people traveling 30, 35 hours to get here from all over the world to come together. And there's a question here. Who affects policy more, the central bank in the country or outside of the country? Does Bank of Japan have more effect on longer-term yields right now in the U.S. than Chair Powell? These are some of the questions at a time where this is a very global economy that is splintering.
In full disclosure, folks, within the wonderful tone here of the Kansas City Fed, I've seen more of the chairman of the Federal Reserve Bank of the United States of America in the last day and a half than any other chairman I've ever seen there. They're usually closeted away. Bernanke's up top. This time of year, Bernanke's up top watching the Red Sox. Okay, Powell has been very visible.
Is it fair to say he's more visible this time around compared to 12 months ago because he's in a much better position, Tom? It's so much better for him this time around.
And to your point, and you've been an arch critic, I mean, Farrell, to get him through customs here at Jackson Hole was something with the Fed. But the truth is, you've been a critic, as others, of the mistake of transitory. And there's a couple good charts. Krugman had a great chart about, they sort of jump-skipped. It was ugly, but sort of like transitory is here.
Well, what's the risk now?
I can't do a thing with my hair this morning.
We can sort that out for you. We can sort that out for you. What's the biggest risk now? The risk now for some economists, including Neil Datta of Renmac, others too. I'm going to mention Neil all morning. You know I am.
Yes, of course.
Neil's thinking about the potential for a re-acceleration in the economy, Tom. and maybe reigniting the risk around inflation again. Is that the risk we face this time around?
That's maybe a short-term risk, a traditional worry about inflation. That my major risk is the underestimation of coming out of a major health pandemic. All of our guests today can address where we are in the long COVID theme. They're all writing about it, whether it's China. Adam Posen will be with us in moments. Brilliant on China in the last number of weeks. This pandemic, we still have unmeasured.
The question about the risk, the balance of risks, if you're patient, which we expect to hear from Fed Chair Jay Powell, is there a risk that you get behind? How big is that risk? Do they have the confidence that they can get ahead of it after the fact, even if it becomes entrenched? Are they going to move away from this idea that people actually are going to have inflated inflation expectations?
We're 5 minutes in. It's time for some snark. Define patience. What, 20 years? Wait for this mortgage market to sort itself out? One conversation we can have, if you want to be critical of this Federal Reserve, how screwed up is this mortgage market now in the United States? And for how long, Tom? Is this a generational story?
Yeah,
good luck with that. That's his own story. That's his own story.
That's a Tom Keene problem. I looked at 1,600 square feet in Jackson yesterday, 4 bedrooms. It's got the cow motif and the elk motif. Elk above the door, $2.45 million, and there's no garage.
Just for the record, Tom, I don't think that's a decent example of the rest of this country. Jackson Hole, probably not. Let's check out the price action just briefly on equities right now. We are positive on the S&P 500 by something like 1/3 of 1%. Yesterday was fascinating to see NVIDIA knock it out the park the way they did, and then see the NASDAQ grab off the back of it is just absolutely fascinating. This market a whole lot weaker in the last 24 hours.
We had a 107 on Eurodollar. I noticed that. I thought of you, John.
Thank you, Tom.
There's a little bear
thanks for saying 107 and thinking of me.
outside the door. I was awake at 2 a.m. And, I see a 107 on Euro, and you predicted
This is very emotional. I think it's probably time to get to Adam Posen, TK.
I think we should go. Let's do this right now. We start strong here at Jackson Hole. We always do that at Jackson Hole. And we do it with a gentleman who set the landscape for China in the last 6 weeks. His article in Foreign Affairs magazine, definitive, but far more than that. Adam Posen is a student of the Federal Reserve System at the Peterson Institute, truly one of America's experts on Germany. That's a good place to start, John.
Fantastic. Adam, great to see you.
Thanks
Good morning.
for having me.
12 months on. It's so different. Can you frame for us the difference in the backdrop for Chairman Powell 12 months ago compared to where we are now?
Like you said, last year was 8 minutes. This year's going to be 20 minutes. Like you said, last year was a rifle shot, or I've said that, totally focused on getting the pain. This year is going to be totally focused on fuzzing things up. That we're committed, but doesn't mean we're going to drive the economy into recession. I think Powell will be prudent, best of both Greenspan and Volcker, not claim victory. But yeah, it's a different world.
Sarah House of Wells Fargo a number of months ago came on this program with us, and she talked about the last mile, getting inflation down from the 3s down towards 2. I think you've alluded to it just then. Is the juice worth the squeeze? Is it worth killing the labour market to get that extra 100 basis points of inflation lower?
I and a lot of people would agree it's not. The question is, how do you manage that from a communications perspective? And this is why my colleague Jason Furman is out there, and I'm out there, and others, Olivier Blanchard, are out there talking about potentially raising the inflation target. People say you can't raise it now, but my worry is the opposite, which is you say 2 means 2, but it's going to be another 2 years before we get to 2, and yodi-do. And so I'm wondering if you have a bit of a tension there.
I'm surprised here with John Williams walking by me, I think it was yesterday, the lack of an R-Star debate at Jackson Hole. Your shop, Peterson Institute, has provided real leadership on this through the studies of Olivier Blanchard. Give us an update where Jerome Powell's R-Star should be.
Well, first, he should be substituting the 10-year bond rate for R-Star. I mean, if you go back to Powell's first Jackson Hole speech as chair a few years ago, you'll remember he said, enough with this unobservable star stuff, unobservable R-Star, unobservable U-Star. And I think that's right. These estimates that come out of Laubach-Williams are completely non-robust, don't update meaningfully in real time. They swing hugely.
Starting harsh in the sunrise.
Sorry.
Please.
It's Jackson Hole. It's time to get busy.
That's going to be our promo for the next 3 years. Carry on.
Excellent. But look, I think what we had, and you may recall, I hosted for Peterson a debate between Blanchard and Summers about 6 months back. And then the IMF has their views. Basically, there are a lot of fundamentals that say rates, long rates, which are the proxy for R-star in the real world, should be down back to where they were pre-COVID. And then there's a bunch of arguments saying we're going to have fiscal boom indefinitely, defense spending, green spending, CHIPS Act, industrial policy, and a little bit of inflation premium. R-star should be up.
Well, this to me is a crucial debate because it also raises a question about rate cuts next year.
Right.
If they think that R-star is naturally lower, then the rate will be naturally restrictive, more restrictive, and will cause them to cut. Based on your conversations, there's already been a dinner, there have been lots of sightings. Based on your conversations, where are most Fed members right now?
I think the most Fed members are going to be like they were on inflation a couple of years ago, which is willing to be behind rather than make a big mistake by preempting on the basis of dubious forecasts. In other words, they're going to wait. They're not going to say, I know that real rates are going up because inflation's going down, because some of that's already priced in.
Do you think that's a policy mistake because it loses credibility for the Fed, especially if they don't explicitly state that they are going to allow inflation to be higher?
I think it's a risk. I think it's night and day versus a year ago, Lisa. I don't think the credibility risk is anything like what we were talking about a year or 2 years ago. But I agree. I think that's a risk. If you say one thing and do something else, it's always a risk.
The heritage at the Peterson Institute, the leadership of Nick Lardy in talking about China, you carry it forward with a brilliant essay in Foreign Affairs on what do we do next about China? What should be the Biden administration's 2024 path in this fractured relationship with China?
Well, first, let me say thank you for citing my colleague as well as my own article. And Nick has a blog where he fundamentally disagrees with me. And
well, that's the heritage. Right. That's the heritage of Peterson.
Right. We debate. And so just recommending people read my article, read that. In terms of going forward.
I like that, Adam.
No,
That's
it's
good.
true.
That's good.
Appreciate it. But look, I think going forward, as I put in Foreign Affairs, Biden administration has to be thinking more in terms of suction than sanctions. That because China's problems are real, because I think they did have a turning point with the zero COVID policy and Xi, that there's going to be more people, more money, more capital, more ideas looking to exit. And rather than us deterring China and trying to contain them, what we want to do is put pressure on the regime so that Xi, if he gets paranoid, which he seems to be doing, or gets into self-sustaining, puts up more barriers. And we've seen this movie before. The more barriers he puts up, the more people want to get out. I don't mean literally millions of people, but just the pressure outward.
Well, we can squeeze this in, Adam. I think it's important. We've always given the policymaker there the benefit of doubt. That seems to be the consensus view in markets amongst market participants. There is this question just bugging people. Is it different this time?
Yeah.
Is it different this time?
On the plane over here, John, I reread parts of Ez Vogel's Deng biography, and it goes back to there was this multi-year battle between Deng Xiaoping and Chen Yun about too much austerity, too much growth. And I think we're back to that, except Xi isn't willing to listen to others the way Deng was.
I don't care. Red Sox 17, Houston 1. Are you going to walk down Beacon Street, across that magical bridge, just on the other side of Kenmore Square, to playoffs and World Series with the Red Sox this year?
I'm going to walk to my refrigerator and get snacks and watch it.
There we go.
Adam Posen at the Peterson Institute. Adam, thank you.
Thanks for having me.
You had to squeeze some baseball in there. Was that for the Yankees fans?
No, this is right. With the new playoff structure, John, this has changed.
Yeah?
It's like Premier League, but they changed the rules. With the new playoff structure, the new middle of September is right now, the end of August. It's mental.
You feeling better about this year?
I'm feeling better.
Okay, he's feeling good.
I thought that you were going to talk about Adam Posen's change in garb. I mean, he's like completely transformed man. No shorts, no short sleeve shirt. He's got a jacket on, and he came to set looking cold.
What's great here, folks, I really can't say enough about our team that set us up this morning. Just now, the glow of the sunrise above Bramall.
Which I don't think you can see.
You can't see it yet, but if you had the Bramall cam, it's just behind the Bramall cam. You can see the first light of Jackson Hole.
It's a very impressive green screen, isn't it?
It is. Yeah.
It's tremendous.
It's good. We're going down to Starbucks on 3rd Avenue after this, right?
It is beautiful. I believe sunrise in the next 15 minutes or so, TK. That backdrop's going to look a whole lot better in the next 15 minutes or so. Coming up next on this program, do not miss this, the IMF Managing Director, live from Jackson Hole. Good morning.
Connection lost.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
That was Chairman Powell in Jackson Hole, Wyoming, just 12 months ago, and what a difference 12 months has made. We thought a year ago to get inflation lower, it would mean the pain that Chairman Powell promised. TK, a year later, and here we are with unemployment almost exactly where it was back then.
Let us remember, and you can go right here to Wyoming and the high prices and the working people of Wyoming. A lot of America doesn't feel that disinflation. This is an academic exercise wrapped around a huge body of Americans, John, that are like, I don't care if it's 3% or 5%. This is miserable paycheck to paycheck.
And it could get a whole lot more miserable. But at the moment, Tom, if you look at the aggregate numbers, the headline figures, we're talking about potentially resilience. Lisa, I don't even think resilience as a word captures where the U.S. economy is, just in terms of how the data's come through. It's been so much stronger relative to what we've seen in China, relative to what we've seen in Europe, and continues to be so.
And everyone keeps waiting for it to diminish. Everyone keeps thinking it will eventually stop. And then yesterday, the jobless claims came out lower than expected. The labor market not showing the cracks that people were expecting. And then people freaked out. I think that that's fair to say. You saw a complete reversal. It just took one thing to say, nope, it's still not cracking. And that really raised some questions.
There's been one change in the last week. The retailers.
Yeah.
You just go through them one by one. Theft at Dick's Sporting Goods, flagging the repayments for student loans later this quarter, later this year from Target, from Walmart. Take your pick. I think it was Dollar General yesterday. Dollar General, Tom, talking about pain for the U.S. consumer. The retail earnings we've had in the last week across a select few companies, TK, speaks to the pain that you're talking about in the U.S. consumer that perhaps isn't captured in the overall headline numbers.
The single best chart on this, Liz Ann Saunders and her team yesterday at Charles Schwab showed the equal weight market versus the tech weight and all that, where we've really hit a tip point in the last 48 hours with that retail debacle. What we're going to do at Jackson Hole right now as we begin in the sunrise of this important Friday is take a more international perspective. She is not here at Jackson Hole, but in heart and soul, her institution, the International Monetary Fund, decisively is. Kristalina Georgieva joins us, the managing director of the IMF, off a recent essay on what everyone's talking about, the fragmentation, the fracture of the global economy. Dr. Georgieva, congratulations on the essay that you and your team put together for Foreign Affairs. You speak of fragmentation. How urgent is the need for solution right now? What needs to be done now to begin to a more stable global economy?
It is urgent, and that sense of urgency is lacking, Tom. Why is it urgent? Because we have moved in a more shock-prone world, in a world of more uncertainty. And in this world, we need each other even more than before, and yet cooperation is in a retreat. What does that mean? It means that unless we wake up and we act pragmatically in the areas where we can find common ground, and in the areas where we must find common ground, like the fight against climate change, we will drift into a world that is poorer and less secure. We have run the numbers. Unless we wake up and we pursue this pragmatic collaboration, we are going to be losing about 7% of global GDP in the long run. I mean, that is like wiping out France and Germany from the economic map of the world.
Because of time, Dr. Georgieva, it's so important I get this in this morning. I want you to speak right now to the four major central bankers assembled here in Jackson Hole. The singular call this year is the 5-year caution of economic growth of your institution. You call it slowbalization. How do those four central bankers assembled here get us out of slowbalization?
It is not going to be only the job of central bankers, but yes, they play a role. And their role is to be very careful in assessing how data informs their actions. We are going to see, Tom, after a period of convergence in monetary policy action, tightening rates, fighting inflation, some divergence, because where the U.S. economy is very resilient, I was listening to this discussion just before me, the European economy is not. There is less strength in the performance over there. So central bankers will have to recognize that some specificity in how they approach the fight against inflation and how they link this to their role in supporting growth and employment, how they approach that is going to be a matter of thorough assessment of national data. Let me just make one point about the United States. What we see in the US is very strong demand for services. Very good, but not good enough for the world economy because it doesn't translate into spillover for global growth. And this is why my main point is there would be some divergence in policy approaches across central banks.
Kristalina, is fragmentation inflationary?
Of course it is. Why? Because...
How much so? How much should that be considered?
If you take the main impact of fragmentation through trade, what it translates into is pushing cost of production up on a global scale. How inflationary it could be depends, of course, on how that specifically reflects into cost structures across national economies in the world economy. But the pressure on costs and then through that on standard of living of ordinary people certainly comes when we fragment the world economy.
Kristalina, I just want to squeeze this in. I've got about 60 seconds, 90 seconds left on the clock. You've said the IMF needs more resources. Can you be a lot more specific about what that means? What do you need, and where do you expect those resources to come from?
Well, let's face reality. More shock-prone world means countries need to have more capacity to face these shocks. Today, global reserves are concentrated in a small number of strong, advanced and emerging market economies. 10 countries hold 2/3 of global reserves, and all the small, medium-sized countries hold less than 1% of global reserves. This is where the IMF comes in. We are the insurer for the uninsured. Today, our size, $1 trillion lending capacity, is just not enough to be the buffer against future shocks that we all anticipate are going to be happening. And also what we want to see is reliance on own resources. We are discussing with our membership to bring the quota resources of the fund again above 50% of our funding level. Today they are at 40%. So we are talking about a not a minor increase, but I think everybody understands that this is a provision of a global public good. If the IMF cannot hold financial stability in vulnerable countries, that is hurting not only those countries, it has negative spillover for the world economy. So
Kristalina, thanks for joining us today.
About a couple of $100 billion that we want to see being lifted up in our lending capacity.
Well, that was the punchline I was looking for. The IMF Managing Director. Kristalina, thank you. It's good to hear from you. Thank you. Thank you very much. Tom, I would argue perhaps an institution struggling for relevance in a fragmenting world. That's the brutal assessment of what they face at the moment.
I strongly support that idea. They are struggling for relevance away from the distractions of Argentina. In her essay, she talks about the train wreck of Zambia. They've got these major, major headaches wrapped around what the four major central banks do.
Chairman Powell, just around the corner, 10:05 Eastern Time. The preview up next with Neela Richardson of ADP.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Attempted to get you towards the weekend. Let's check out the price action on the S&P 500. Equity futures here, elevated by 1/3 of 1% on the S&P. The Nasdaq trying to bounce back up 1/4 of 1%. Yesterday, I think brutal. And I'm going to say it's brutal, not just because of the move, but the move relative to the news. The news was good. NVIDIA knocked it out of the park, Bramo. It's what we wanted to see. And the Nasdaq faded and faded fast.
And the fact that it was up, that the NVIDIA in particular was up almost 7%, and then all of that almost retraced, and everything else just sunk down. Sell the news, right? I mean, that basically is what everybody was saying.
It's an interesting time, but it's also August, and we're addicted to up. I mean, the pullback, have we had a correction yet? I mean, it's great.
What are you looking for, 10%?
It's terrible, but to your point earlier on retail, this is always true of a correction. There are selected sectors that are absolutely hammered, and that's what we're seeing.
What surprised this year? The U.S. economy. What underpinned that? Consumer spending, discretionary spending to be specific, airlines. Beyond the airlines, cruise operators. Is that going to start to fade into year-end, Tom? That's a big question. The retailers alluding to that over the last week, flagging that they think there's a potential for that to happen. The problem is, Lisa and I talked about this last week, Tom. It's the economist who cried recession 20 different times over the last 12 months. You've got the retailers flagging weakness again. And I think a lot of people are shrugging their shoulders and just thinking, well, I've been burnt by that view a million times over.
I'm not going to mince words about this. The people, the fancy people that wear Montclair ski jackets, it's just as simple as this. They haven't been touched
sitting next to each
by
other
the recession
the whole time,
yet.
seriously.
I don't know,
we're 30 minutes into the program.
He's already trying to tweak you.
There's a part of America that has not been touched by this recession. Right now in Jackson Hole, Wyoming, 2/3 of America says, you guys are nuts. We're in a recession. That's the bottom line.
Do you want the feedback this morning? Great reporting, beautiful sunrise. Old school locals used to criticize the tourist newbies that incorrectly added the Hole to the official name of Jackson, Wyoming. That's the feedback this morning, Tom. Is that helpful for you? The ski bums.
I've been here like 17 years. I'm going to Jackson tonight for the first time.
Can I tell you?
I'm going to some steakhouse and have fish. It's going to be great.
Nice.
People call it J-hole who are, talking about it in other places, which is just dreadful. But, just to give you a sense of just how wrong we are.
Very wrong, apparently.
Very wrong.
Turn to the bond market just briefly. Two-year yield still in at around 5% at the moment. That drift higher in yields over the last month has been pretty impressive. 422.95. I think in the past week,
on a 2-year?
cycle high was about 436 on a 10-year, Tom. So we've come back from those levels, but that was a shocker for many. A shocker for many.
Did you see the 3-month T-bill yesterday? It was like, wow. I mean, these are some serious surging rates. Lisa, under surveillance this morning, it's our weather report from Jackson Hole. John, 48. Last year at this time, it was 42.
And raining.
And the 6-degree difference is like, this is like balmy.
It makes a difference.
It makes a huge difference on a perfect
I thought
day.
you were going to say something about the bond market, but maybe not.
No, I'm doing the weather report. That's what we're doing now for under surveillance.
From the weather to foreign exchange, let's squeeze in the euro and do something sensible.
It's natural segue.
Okay, you said we saw 107.
Yeah.
We're back to about 108.11, Tom, on the euro.
Swissy did not confirm the gloom in euros. Seriously, Swissy did not go stronger on this recent move in euro.
In Germany, the data, Tom, less than impressive. President Lagarde, you catch up with President Lagarde a little bit later. Run us through it. This is a tough spot for her.
The list of things I can't talk to her about. You can't talk about Germany, Tom. We'll see how that goes.
Don't talk about rate increases.
This morning.
Don't talk about policy.
What we're going to do right now is talk about the most important person in the lodge here at Jackson Hole. It's a bunch of fancy academics writing fancy papers. What they want to know is, what do the paychecks of America look like? With that leadership is Neela Richardson, chief economist at Automatic Data Processing. She, more than anybody else here, has an understanding of the American payroll, the American labor economy. With Parchment from the University of James Bullard of Pennsylvania, Maryland. Thank you so much for joining us. What does ADP say right now? What does the payroll of America look like right now?
It's solid. but it's fragmented. And we've seen notable declines in wage growth. After last year, wage growth moving sideways, we're actually seeing some traction downward. So that's good news to amplify the Fed's already good news going into this Jackson Hole meeting. And by the way, wow, what a view. You guys really...
Do you like
it's
that?
Beautiful.
Matt Timmons did that. He moved the mountains 6 feet this way just to get the shot right this morning. I want to talk to you seriously about the dynamics of wages and inflation, the real yield. There's an optimist view that, yeah, the real yield's there, but wages will stay strong. Do you agree with that? Or do wages come in even while the real yield goes up? That's not good for America.
You know, that's the open question. There's a sense that where we've seen the highest wage growth has been for low-skilled workers with low pay. Now, let's be clear. Even though we've seen double-digit wage growth for almost an entire year, that translates to less than $5,000 in your average paycheck in low-skill industries. So it sounds like big double-digit numbers we should be concerned about when we look at pay growth. But for the person on Main Street, it doesn't really fill the gas tank and buy the eggs and pay for education and healthcare in the same way.
Let's carry on this conversation. I think this is so important. Why are people in this building in front of us, when they get together every year, concerned about pay growth? When everyone else, away from all of this, loves a pay rise. What's that about?
Well, you know, wages are the bridge between the labor market and the inflation, right? And so you want to make sure that that bridge is going towards lower inflation, not higher inflation. And in that sense, it matters for Main Street, too, because you want real wages to grow. You don't want nominal wages to grow. And what we've seen is a lot of nominal wage growth because of high inflation. Now, that's shifting as inflation goes down. The question is, will the persistence and strength of wage growth built by an undercurrent of productivity continue? Or was this all just churn and competition prompted by inflation? And I think that's the critical question for me in these many years.
Big pay deal from UPS, big pay deal for American Airlines pilots. A lot of people are going to see those headlines, go to year end, sit down with their manager and say, I want some of that. Why don't you think that's going to happen?
Negotiation at the end of the year is always pretty tricky. And one of the biggest questions we've heard from employers is, how do you negotiate a salary in an inflationary environment, right? Because you can't have a sense of what's next year's going to look like when inflation's all over the place. And now we've seen that trajectory go down. The balance of power has shifted back again to the employer. So what's on the table in terms of negotiation? It's remote work, it's benefits, it's wages, it's this whole package of things. And yes, there are some pockets and some occupations that can win the wage negotiation argument. A lot of other people are just going to see smaller bonuses this year.
Let's underscore this, especially because we do get the United Auto Workers vote at 11 a.m. Eastern today, and that could potentially have material impact on Detroit and all the auto manufacturers there. Are you saying that when we say the power is shifted to labor, that's overstating the fact, and that's not the reality? It's just a small pocket here and there, and the rest of them, it's the employer saying, get back to work, and you're not going to get that big of a pay rise.
The fallacy of the labor market, as it's discussed, is it's talked about like a monolith, when it's really just an aggregation of microcosms. And some are strong and some are weak. And so when you have a union negotiating a wage in a market, and it's early, and there's not enough coffee in this world for that.
Here, have some Tang. Would you like some Tang?
Are you in a late night with Jay Powell? Carry on.
When you have a supply-constrained market, a collective organization bargaining structure, and the need to increase pay, that's like a perfect storm, right? But that's not the whole market. And so you're going to see different opportunities for wage growth in different microcosms of this market, and we can't talk about it as one broad stroke.
I was making a joke earlier, but it's not funny. The people here really listen to you in market economics and payroll economics. I want you to speak to 4 central banks right now. Are we beyond where we can aggregate any nation, any central bank, any America into one set of economic analysis, or are we out front of John Edwards where it's 2 Americas, 3 Americas, or the 28 Americas that ADP looks at?
Why I love this question.
Are you okay?
Yeah, you did great.
Okay, thank you.
Why I love this question, and why I love the theme of this year's conference, structural constraints or structural shifts in the global economy, is that it's a recognition that the inflation story has been mutated by the pandemic, and the trajectory we were on globally in terms of inflation has been permanently shifted. And that means that we can't just be cyclical, we have to be structural on the drivers of inflation over the long term. And the sense that once we get through this episode, we start cutting rates and things go back to normal, I think that's a little optimistic. That misses the whole point that inflation could rise again next year or 2 years from now or 3, that it's not going back to a 40-year slumber. And that's the important point.
Some people are talking about the long and variable lags. We laugh often, how long, how variable, what are you talking about? Within the labor market, how much have rate hikes actually diminished some of the power that you've seen in hiring and the ability to get jobs?
You know, it's been shifting. So we're still at record lows in unemployment. And what we've had is when one door closes, like large firms in tech hiring, another door opens, like small firms. In fact, over the summer, 60% of the new jobs added were from small firms with under 50 employees. These were the tigers of the labor market. Very different this year than last year. We also saw the hiring be very different in the motivation. So before, last year, it was a lot of replacement hiring. Now you're seeing firms actually add to headcount. So yeah, the numbers are going to be smaller, but they're going to be more real and more persistent and more sustainable. It's not just replacement.
Let's not do forecasts. Let's do best guesses. So
I
12
love
months
best
ago,
guesses.
best guesses,
which is another way of saying forecast.
We're being kind. Best guesses. 12 months ago.
It's forecasts you don't backtest later. So.
Exactly. We're being kind about this. 12 months ago, unemployment around 3.5%. 12 months later, unemployment around 3.5%.
Yeah.
When we do this again together next year, where do you imagine, best guess, unemployment's going to be?
I think it's going to be around 4%.
Which is pretty marginal.
It's pretty marginal.
Is that consistent with getting inflation back towards 2% in your mind?
This is what I'm talking about, of the mutation in the inflation trajectory, because those labor shortages are persistent. They're not going away. If you look at the demographic trends of the United States and in advanced economies in Europe, you see an aging population, a population that is non-working growing faster than the population that is working. That means there are fewer people producing the stuff that the population needs, and that is inflationary.
The heart of the matter, you did this at Maryland with their great public policy program. The bottom line is the middle of America is being carved out. ADP sees this in micro data to 4 decimal points as well. What's the public policy prescription for the next president of the United States and, frankly, the next chairman of the Fed to help the middle of America that's being carved out?
You're giving me 30 seconds for this answer?
No, 28 to go. We'll extend it.
You can have a couple of minutes for this one.
I think it starts with skills and job growth, because one thing I haven't heard yet, though I expect to hear today, is this innovation boom that is at the precipice of changing how all of us work. And the question for middle America is, can they evolve with the change in technology? Right now, it's a choice. That technology could make middle America more productive, which is when wages grow for the right reasons, and no one argues with wage growth based on productivity. That's higher profitability, that's higher standard of living, and it's disinflationary. What people do argue with is when it's displacing labor. And right now, the verdict is still out. I think the hope and the energy is around making workers more productive, and that could be helpful.
You sat next to Jay Powell last night at the dinner. So what did he tell you he was going to do? What's he thinking?
I think it was some guitar playing in his future, maybe some golfing.
Okay.
Hopefully some visits with his family.
Oh, nice.
So
didn't talk about September 20th, big event.
He's retiring? Is that what you're saying?
Yeah, I think that those long-term plans, remember, we're talking about the long-term
the long and variable lags in his work schedule.
Not the short-term immediate future.
No, the long and variable lag for Jerome Powell is a distance to the next Dead concert.
He loves that, doesn't he?
He loves that, yeah. He's like, massive, yeah.
Yeah. Neela, this was fun. We've got to do this again.
It's always
do it
fun.
again soon. We won't wait until next year, don't worry.
Backdrops like this.
Can we take a shot at this? It's just beautiful. It's just beautiful. It's stunning.
Yes, definitely.
What a great location, TK.
It is. I've been looking for bar this morning in Elk, and it's a little, they haven't really showed up yet.
You've been looking for a bar or an Elk? I wasn't sure.
Bar.
Elk and a bar, I don't know.
Bar, they say bar out here, they don't say bear.
Oh.
They call Bear what?
Bar.
What
are you talking
stop
about?
It. Stop it. I think you had a few too many and someone started winding you up last night. That would be my best guess. Neela, thank you. Neela Richardson of ADP. Mike McKee coming up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I would say that we are in a position in Europe now where the Eurozone economy is basically stagnating. We are now certainly in the restricted territory. And we got into the restricted territory by rapidly hiking the rates so far. Whether we are in a restrictive enough territory remains to be seen. And this is something that we'll only see from the inflation data that will come in the next spring.
Boris Vucic there, the ECB Governing Council member and Croatian National Bank Central Bank Governor, came very, very close to saying the S word. Not stagnating, stagflation. In Europe, it is a very different backdrop to what we're experiencing here in the United States, where we're making progress on inflation but still witnessing a robust economy. In Europe, anything but. They have an inflation problem and parts of the economy, parts of the Eurozone, TK, in recession. Dare we use that word stagflation to describe what Europe is experiencing right now?
With a war in Ukraine, and I think you can say, I'm not knowledgeable enough to say you could say full European recession, but I don't care about any NBER stuff or other analysis. Boy, interview after interview, data after data, it's recession.
Where's the growth going to come from? I mean, if Germany is really the one that's leading the recession, and it really is driven in part by what's going on in China, and their economy has not been as disconnected from China in any way, shape, or form, the same way that the U.S. has.
$16,000 business class plane tickets to Paris. That's what's going to save them from recession. That's how silly this is.
With what airline?
Well, it depends.
United? Oh, yeah, that's right. It's based in the U.S. Carry on.
But the bottom line here is what's saving them is this hope and prayer of an elite. I'm going to associate it with Mr. Macron of France, which is probably unfair. But there's a whole other Europe out there that's flat on its back. There's no other way to put it.
Big time. Let's whip through the price action just to get you all up to speed and prepared for the day ahead. Equity futures on the S&P 500, slightly positive, up by 0.4%. In the bond market, the 10-year cycle highs in the last week or so. Back to way since then, 423.54 on a US 10-year. Going into Chairman Powell at 10:05 Eastern time, looking for a speech maybe a little bit longer than the speech from 12 months ago. But I just want to sit on this just for a moment. The numbers we had from NVIDIA in the last 48 hours, supported this equity market rally on the tech side of things in a major way, and this equity market faded. Mike Wilson of Morgan Stanley, Lisa, saying to Bloomberg Radio that this is a sign that this rally is exhausted. We know Mike's view coming into the year. We know how difficult it has been, but I think many people
shows how much these tech stocks are interest rate sensitive, that there is this concern that if rates go higher, they are not going to be immune, and you are going to see a valuation reset, which is the reason why you have sell the news, even though the news was incredible. I mean, the amount of beat was really out of the water.
Yeah,
I mean, this is another one, exactly.
They did it in May. They did it again in August. That stock's slightly negative in the pre-market this morning. TK equity futures slightly positive, up a half of 1%.
Real 101 to the optimist is the VIX is under 17, and I know there's a lot of different Dean Kernot-like noise and all that in the VIX, but I just, we're not even back to a correction, although, as we said before numerous times, so many people are looking at retail. I'm in shock over, say, what Nike's done for a number of days. I need a wide shot here. This is very important, folks. I just want you to understand that this morning on Bloomberg Surveillance Worldwide, as John brings in our leadership here in umpteen years at Jackson Hole, we're cowboy hat free this morning. This was an executive.
I'm not sure why.
Executive decision.
Executive
this
decision.
is Bramo's decision, and we decided this early in the morning, cowboy hat free.
This is the first time I've seen Mike McKee, because he's a superstar walking around.
Oh, yes. He
walking around the lodge.
ground.
Oh, yeah, just ignores me. Walks straight past us. So, Mike, it's good to see you.
It's nice to see you too, John, and I'm glad I had a few minutes for you.
Chairman Powell, a little bit later, you're going to give us the official preview. How different is this address going to be compared to the address that we got 12 months ago?
Well, it's probably going to be about 10 or 15 minutes longer, for one thing. I don't think he has the same urgency in sending a message. Last year, the markets and the Fed were wide apart, and he wanted to bring it back closer together. This year, the markets are doing what the Fed wants. I mean, yields are up, and that helps make policy more restrictive for right now. We don't know where they're going to be September 20th, and he's going to probably say, we're going to wait till September 20th, or at least till the next jobs report and the CPI and the PCE inflation numbers, and see if they feel like they need to move again. And the bet is they won't, but he's going to leave his options open.
There's images on Instagram, folks. You can see this of Mike McKee leading what he calls a perp walk as the central bankers walk down here in a number of hours to gaze out at the vista behind us. Ueda, Lagarde, Powell, Bailey, not here this year. Are they unified? Is there any kind of a unified message of these central bankers, or is it, as Bremer would say, every central banker for themselves?
No, I think strategically they're all unified because they all have the inflation issue they have to deal with, and certainly the UK and the Eurozone have the same sort of inflation problem as the US. It's too high. The Japanese, it's too low. But the message from all four of them, when you throw Ben Broadbent in, who's going to speak tomorrow, is basically going to be stay the course. What we're doing now, we need to keep doing. We need to keep the pressure on inflation in those areas where it's too high, and in Japan, we need to keep inflation higher.
Yesterday, former St. Louis Fed President Jim Bullard was on Bloomberg Television with you, and he said this: I think the committee should take a little bit of a victory lap here. You were at the dinner last night. How much of a victory lap were people doing?
They're humble about it. Basically,
but they're still doing it?
Basically, they do still think that a soft landing is possible. They worry about the possibilities of some exogenous event, but they know that this, as somebody was calling in a research note I read last night, the last mile for inflation is going to be the most difficult, and so they know that it's still going to be a bit of a slog.
How much is the balance of risks clearly shifting among the majority of the members to killing off this proposition of a soft landing and not letting inflation get out of control?
I think that it's a dual message that we can achieve a soft landing. No Fed official is ever, or central banker is ever going to say, yeah, we're going to have a recession. And you were talking about Boris Vucic, and yesterday I also talked to Joachim Nagel, and they both said no recession, even though Nagel's economy is flat on his back. But they are going to say we can get a soft landing out of this, but we are going to do what we need to do even if we don't get a soft landing, because they need to keep the markets where they are.
There is a splintering on this committee. You've covered it really well for us over the last several months. We've heard it this week. The Boston Fed presidency 24 hours, suggesting the resilience of this economy suggests to her that we might have to do more. Patrick Harker, who will be catching up with you a little bit later from the Philadelphia Fed, has spoken to various media outlets and suggested that he thinks we're done. Can you shed a light on that? Shine a light on just how much splintering there is at the moment on the committee?
These are tactical differences rather than strategic. Strategic, yes, we're going to raise rates, and we're going to keep them there for a long time. Tactically, do you go up by 25 basis points more, or have you done enough? That's the question that they're all debating at this point, but it's not really a huge division among them. And I think that basically the feeling on the committee is that the data will tell us what to do. If we see inflation start to rise, slam dunk, we're going to raise rates. Now, I don't mean just by a tenth or two that's base effects, but if we see some underlying inflation pressure, then we raise rates. If we don't, we can pause and wait for the next meeting, and all three of you will be debating that in November.
Back to Fed 101, as Chairman Powell speaks this morning, how much longer is his tenure? What is his timeline? This is not his last Jackson Hole, is it?
Oh, no, no. He was just reappointed last year, in 2001, by Joe Biden. So his tenure will end in 2025. And
really, that far out?
Whichever president is elected in 2024 will get to name the next Fed chair, whether it's Powell for a third term or whether it's somebody new.
Well, based on the commentary we've had from the Republican Party, it won't be Chairman Powell. Does this institution have one eye on the politics developing in America?
One eye in the sense of what could it do to the economy, but they insist, and you read the transcripts of previous meetings, and there's always been these debates between Republicans and Democrats, and we've had government shutdowns, and they don't talk about it. They don't let it enter their considerations. They are sensitive to the public, but not to the body politic, as it were.
Have you got the check to write for McKee? That was longer than 2 minutes.
It is. Well, he's paid by the syllable, so, it works out.
Thank you, Mike.
I put it to a new hat.
McKee's got me going to the Gun Barrel Steakhouse tonight.
Is that what you're going
to
tonight?
Manly Steakhouse.
I can't imagine you in
I'm
there.
trying to get in. I mean,
He's wearing a bow tie to the local diner.
Yeah.
I don't know. It's
I'm pretty sure it's Western themed tonight. Do you have your Western gear?
No, I only have this.
I heard about that
Yes,
too.
and if you don't wear Western, you're in trouble.
Western Fridays.
Yep.
Big deal, TK.
Then I'm in trouble.
Coming up, John Lipsky, former first Deputy Managing Director at the International Monetary Fund from a beautiful Jackson Hole, Wyoming. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Steve
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg.
Heading into Jackson Hole, we're not expecting a major policy shift out of the Fed.
There's some anticipation that Powell will talk about maybe higher structural rates, higher R-star.
Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit.
I still think he's going to embrace that narrative of higher for longer, just given how resilient the incoming data has been.
I don't think we should be looking for any big surprises. You know, my sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From a beautiful Jackson Hole, Wyoming, for our audience worldwide, good morning, good morning. The second hour of Bloomberg Surveillance starts right now on Bloomberg TV and radio, together with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. 12 months ago, looking out 1 year, this is not where we expected to be. This Federal Reserve has gone a whole lot further than we thought they would. This economy is a whole lot stronger. Tom, a lot of people got this wrong.
I'd take it from 12 months ago, they got it wrong, to even 4 months ago. The urgency of this Jackson Hole is something I don't think we even knew weeks ago. There's a tone here that I simply didn't predict, say, 2 months ago.
2 months ago, maybe a month ago.
Yeah,
this data, Lisa, has just been so much better. So at 10:05 Eastern Time, when Chairman Powell speaks, how different will this speech be to what we heard 12 months ago?
Last time he came around, it was all about pain, and how the pain on one hand of higher rates is better than the pain of having to struggle through inflation. And now we have inflation that's lower but still higher than it has been for years, not getting back to 2%, even by the Fed's own projection, until after 2025. Where's the pain? Is he going to talk about it, or is he going to reject pain and say, we don't need pain, we got it under control?
Well, we got it under control. I'm not sure how much control there is. They're going to do the walk this morning. McKee choreographs the walk where they go out and point at the mountains. I have no idea what they're pointing at, but Alan Meltzer climbed that high 20 years ago. But they're going to do the walk out. And to me, the question, John, you've mentioned this, the international tensions right now, the incredibly important paper by Barry Eichengreen to come tomorrow here. The international tensions here are underestimated by the American media.
Ex-US, strip out the United States. Parts of Europe in recession, really struggling to generate economic growth. Yeah. China struggling to respond to the slowdown they're experiencing at the moment. And yet you can still feel this slight excitement, just a little bit, about the prospect for a soft landing here in the United States of America.
No,
and I cannot tell you, Tom, that makes people nervous. That makes people nervous that maybe they think the job is done. Now, what they're willing to say and what they think, there might be two different things, but you can sense it, just in terms of the commentary we've had over the last few months.
Is that hope? You know, I do in all my reading, when I see the word hope, I circle it. Are we hoping for a soft landing, or is there any evidence of it? Yeah, they got a 5% American GDP. Let's pack it up and go home.
I will just say this. At 10 a.m., 5 minutes before Fed Chair Jay Powell takes the helm, we get University of Michigan sentiment survey, and we get inflation expectations over the next 5 to 10 years. I know how you feel about it, and I know how you feel about it. However, it does raised this question of the risks of waiting too long. What does that do to inflation expectations as people start to see year over year their costs just...
And there we go.
What was that?
Climb, go on.
Bramo dancing.
She was at the $1 Million Bar last night going...
All right, let's move on.
What we do, what's important here, I got an email. Do you bring... No, I got somebody, John, somebody emailed me. They said, do you bring the Bramo cam when you're on the road? Yeah, the Bramo cam's right over here, looking at the gloom. You know, we live stream it as well.
That's bonus content. That is too.
John Lipsky's, we got a wide shot. For those of you on radio right now, Dr. Lipsky's looking at us going, what did I get into this early in the morning?
Patience, John, please. Please. Let's get to the price action for you. We are about 26 minutes away from the opening bell in New York City, and this is how things are shaping up. Going into the opening bell on Wall Street, equity futures are positive by 0.4%. We really are trying to bounce back from the weakness in yesterday's session. The fate of today, arguably in the hands of one man, Chairman Powell, potentially. That seems to be the view. That address from Chairman Powell, exactly 1 hour and about 30 seconds away. Lisa, have we got a countdown clock for that?
Well, we should have a countdown clock.
Come on.
It's just like 1 hour.
We got a countdown clock for when the first elk comes out.
In the bond market, 424. Yields going absolutely nowhere. Cycle highs, new cycle highs. This bond market has impressed in a monster way. Think about where we were post-SVB. Post-SVB, back in spring, cycle over, hard landing, financial conditions are going to be too tight, banks are going to fail, and we'll be talking about rate cuts before you know it. It's the end of it. Literally the day before it failed, a 2-year yield at 5.08%, cycle high. All of a sudden, end of the summer, data's decent, and a 2-year yield, Tom, is just south of the cycle high we were at the day before SVB failed.
The nominal yields that the financial market keeps up with, but what I'm looking at is the real yield in the convexity, the acceleration that we've seen in the real yield is sobering. Right now, 1.91%, I believe it is, on the 10-year inflation-adjusted yield. A week, days ago, it was 2%. That's stunning to all of these economists assembled.
Would you like to frame our next guest?
Let me frame our next guest. This is a joy as well, providing international public service and joining the IMF a number of years ago. This is John Lipsky. Dr. Lipsky, of course, owns a high ground from Stanford Economics. His work is at Salomon years ago, and we are thrilled. He traveled all the way from Europe to come here.
That's very kind of you, John.
Very,
John, it's good to see you. Thanks for being with us. I know one thing that you're focused on, and many people are focused on it as well, also people at home, listening, watching, our audience, the changing relationship between this labour market and price pressure. What do you think we need to focus on right now?
Absolutely. The big question is, do wages follow inflation or do wages cause inflation? So far, the data suggests that wages follow inflation, not the other way around. And I think that reflects some big changes that have happened in the economy that haven't been clearly, some structural changes in the economy, international economy, that haven't been so clearly recognized. And that is the opening of markets in the 90s and the aughts and in the 2010s has turned many producers into price takers, from price makers. In the past, in the 70s, producers, especially in the U.S., were just willing to push costs along, pass them along to their consumers. As markets internationalized, that no longer worked, and they had to manage their production to markets, price takers. And as that has changed, the way wages have been settled as well. And so what we're going to find out is a test in this current environment. Is there any reason to expect wages to continue to cause inflation in the future? If not, then a soft landing near the Fed's target is a real possibility.
I don't want to bury us with a history lesson right now, but to have Eichengreen here and Lipsky and others, we celebrate the 50th anniversary of John Taylor's PhD at your Stanford. 40 years ago, this is at Alan Meltzer and Carl Bruner's Carnegie Rochester, much like Jackson Hole's summer conference. Taylor changed the world by beginning to talk about a rules-based architecture. Is that ancient history, or can we get back to central bank policy as people like John Taylor prescribed?
Well, there was just a very interesting conference at Stanford to honor that 50th anniversary of the Taylor Rule. And there's certainly a great interest, renewed interest, in central bankers going back to some kind of more clear rules-based approach to setting policy, not just setting a target, but explaining in a clear way what they would do to get to that target. Right now, we don't have that. And part of it is because, as we've seen, that our models about inflation, which is the target for central banks, hasn't been clearly established.
How much are central banks just basically cycling to keep up with fiscal policy and the fact that there's been so much debt and so much stimulus pumped into the economy, and they're trying to figure out new models for something that is modelless, that has no paradigm in previous history?
Well, that certainly has been a challenge, and it's one that looks like it's going to be there for a while, because a great move toward fiscal discipline doesn't seem to be in the cards right now anywhere in the world. We're going to have high fiscal debt for quite a while. But of course, part of this, the question is, we've seen central banks also take different kinds of action with regards to public debt. QE in the U.S. and elsewhere now turned into QT as they work down their balance sheet. This is going to be a complex challenge, and there is similarly is no model right now.
And that's where I wanted to go. This question of the Federal Reserve balance sheet. Yesterday, the total came out. It's down almost $1 trillion from the peak, just north of $8 trillion. We still have a long way to go. I'm just wondering how much that's contributing to a tightening in financial conditions. That's sort of the story right now, especially on the long end.
An excellent question for which we don't have a clear answer. What the Fed has decided is that if they go, let's call it a rules-based approach, and say the same amount every month or every quarter, that reduction in their balance sheet, that will keep markets calm because it's predictable. Sounds like a rule. But in fact, we don't have a clear view about how this is all interacting. And as was going to be discussed here at Jackson Hole, how well the Treasury market actually works, the Treasury bond market actually works, has been changing with rules and regulations have been introduced. And we'll be talking about, is there a way to make that market work more efficiently?
We're so honored at Bloomberg today to have you with us, with Christine Lagarde later on, and Dr. Georgieva with us earlier. And all of this is about fragmentation. You lived on airplanes for X number of years to the IMF, fighting against fragmentation. How close are we to the blocks, BLOC, the blocks that we studied as kids?
It's a wonderful and important question, and not easy to think through because of the following. We started in the post-war era with blocks, economic blocks, based on ideological and geopolitical oppositions. Markets started out fragmented. Post-1990, we've entered the period of what I call true globalization that had profound effects on the world economy and enormously positive. Now, there's no instance of an emerging market economy that has sustained growth without being connected to global markets for goods, services, and capital. So the question is, they understand this. Is it possible that they will allow renewed geopolitical great power conflict to break up those markets that have brought, in essence, will they kill the goose that laid the golden egg?
So we need to finish where we started. With this fragmentation, do producers, to use your analogy, become price makers again?
That's a risk. That's a great risk. However, those who are leading or part of this renewed geopolitical tension also recognize that their economy depends very heavily on access to markets. This is how this will be resolved is one of the key questions of the coming decade.
John Lipsky, this was wonderful and deeply thoughtful. Thank you, sir. It's good to see you as always. The former First Deputy Managing Director at the International Monetary Fund, Tom, with some strong stuff to think about with regards to a country I don't think we named, China.
No, we underplayed China this morning with a focus here on the four major central banks. It's true, but the key word from Dr. Lipsky I heard there was complexity. These are not simple concepts. And in the American media particularly, and we're as guilty of this as anything, in the Bloomberg News team, polices us and tries to show us the complexities that are real right now. Post-pandemic, they're a new level.
I would take it a step further and just say that China's the elephant in the room here and what they decide to do, and Xi Jinping's reluctance to really come in and support the economy in a material way. I mean, he came out with some half measures, or the Chinese authorities, yet again, it lasted for about 10 minutes with a bit of enthusiasm this morning, and then everyone was like, you're not doing anything.
It's not getting it done, is it?
It's not getting it done. And at what point does he convince people that he wants to get it done when he doesn't seem to want to give what he calls welfare, and he doesn't want to necessarily connect to the international economy at the risk of risking national security?
This goes back to something John was talking about. There's a reluctance here, Tom, to adopt the Western model. A real reluctance.
Oh, absolutely. I mean, we want to get halfway back. I mean, some of the essays here on China say precisely that. It's where is the first initiative to get back to something that Deng discovered 3-4 decades ago.
The opening bell is just around the corner in New York City. We've said it a few times. The fate of this session in the hands of one man, Chairman Powell. That speech, 51 minutes away.
Reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
This reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy. There's some talk about base effects fading and going the other way during the second half of the year, so we'll see if that occurs.
The former St. Louis Fed President Jim Bullard weighing in on the global economy and Fed policy in the United States. I have to say, typically I'd say there are things you can say when you're an official at the Federal Reserve and things you can't say. And then when you're no longer a Fed official, you just sort of open up, you're unleashed.
It's like a change man.
But with Jim Bullard, I don't think it makes a difference.
Come on,
I think Jim Bullard said what he thought when he was the president of the St. Louis Fed, and he says what he thinks now.
The great thing about Bullard right now is I think they did the shot from the football stadium at Purdue, and he's got the whole Purdue Boilermaker thing behind him, like he's rah-rah. But I'm going to give him at least till Purdue beats Michigan this year. I'll give him at least till then. I don't know when the game is ginormous. Okay. You know.
Well, I've promised people that I'm going to watch a college football game this year, so we'll make that happen. I want to check in on the price action for you. We are about 13 minutes or so away from the opening bow. Your equity market is shaping up as follows. Equity futures on the S&P 500, positive here by 0.3%. On the week, we are just about positive, but only just after yesterday's losses. In the bond market, we've backed away from those cycle highs on a 10-year yield of about 4.36. We're back down to about 4.24.53 going into that speech from Chairman Powell, Tom, in the next hour.
It is, and this is a wonderful moment now as we go to that speech with the central bankers gathered here on, yes, U.S. economics, but of course, international economics. And they will listen more to Barry Eichengreen of Berkeley than anyone here. He owns the high ground from Golden Fetters, his classic book on gold, until what we see with globalizing capital and now his intense focus on debt and the debt mess we're in. Dr. Eichengreen, thank you so much for joining us. How bad is the debt mess we're in?
Well, I think it's a big change from the pre-COVID days. Governments are going to be constrained if and when we have a global recession, if and when a bad thing happens. They have a lot less room to run fiscally because of the increase in public debts worldwide.
As usual, you've been out front on this, and the phrase that I hear from you is, and you say it with respect to the institutional pressures and our political leaders, the modern medicine that we have. What is the more stronger medicine we need to take to get control of our debt and our ratios?
I think we're going to have to learn to live with these high levels of public debt that advice policymakers are getting from the Bank for International Settlements and the IMF about bringing down debt ratios. That's unrealistic. We're not going to be able to grow out of these higher debt ratios. We're not going to have a more favorable real interest rate going forward than we've had in the past. We're not going to be able to run primary budget surpluses for long periods of time. So I think we're going to have to tiptoe likely through this problem and manage these heavy debts.
Tiptoe, your words, manage. Other people might say this ends in disaster. Barry, what's the argument against that?
For countries like the United States, there is a big, remains a demand out there from foreign central banks and the international private sector for U.S. Treasury bonds. So I think the U.S. government is an exception to the general rule in that it has room to run. Other governments are going to have to reform fiscal institutions, worry about fiscal transparency, do all the things that the IMF and others have been recommending for years.
Does it basically suggest that longer-term yields in the U.S. are where they need to be? That basically the term premium is going to be significantly higher? That essentially what you see is what you get?
Well, I think the term premium can come down a bit, but not back down to pre-COVID levels. I think everybody understands that we're in a new world with higher interest rates. The question is how much higher, and I wouldn't be a pessimist about that.
How much has the debt that the U.S. has incurred in particular driven a lot of the inflation that we see? How much can we really basically write the book and say helicopter money actually does cause inflation?
Well, I think the fiscal stimulus that we in the United States did in 2021 was a contributing factor to the inflation, and there will be debate about that today because there were other contributing factors as well, the supply shocks, a variety of other things.
Take your study of debt, your view on the inflation-adjusted yield, which is maybe what the adults, the pros, look at, and bring it over to the Eichengreen application of monetary policy. And there's a whole R-star debate in that. Are we going to move away from a 2% regime? And how do we search out an anchored level that is higher?
Well, I think the Fed has to bring inflation down to 2% before it really opens that conversation. We saw in this recent episode the importance of credibility, and credibility and 2% are synonymous for the time being. The only time you talk about changing the regime is when you have everything under control.
Let's go down the hall at Berkeley to Brad DeLong's office. You and I are going to walk in with Professor DeLong, and I'm going to say to both of you, with your academics and his more political view, what's the price of bringing inflation down to 2%? What's the cost of that to Americans?
Well, so far the cost has been minimal compared to the doom and gloom scenarios we heard about unemployment going up to 5 or 6%. So far, so good.
But that's been your hallmark. You have been the arch optimist against doom and gloom. And how do you respond to the doom and gloom that we hear daily from Lisa Abramowitz, or that we hear out in all of economics? How do you respond to that American gloom that you fought against for 50 years?
Well, look at what the Atlanta Fed Now Tracker is saying the U.S. economy is on track. There's no sign of inflation on the horizon. Yet in this kind of assembly of economists, there has to be one optimist.
Lisa, this is like the GOP today, isn't it?
Yes.
Your name was referenced. Would you like to reply?
Well, I just wonder, at one point, is it unsustainable, this kind of enthusiasm, this kind of growth, right? I mean, at some point, you're not going to get down to 2%. I'm already changing to 3%, 2% for quite a while, even by the Fed's own admission.
2025.
Exactly. After 2025.
Right.
Doesn't that reduce their credibility to some degree?
They have to have a credible strategy for getting to 2%. So this is the classic, give them a target 2% or give them a date, never give them both.
2%. Can we think about where it came from? Is this really about some people in New Zealand in the 1980s just coming up with a number? Is that what we're all doing here? 2%? What is it about 2%?
That's exactly what we're all doing here, but history has consequences.
Can I sneak in one quick? No, you're dead on.
I mean, like,
absolutely dead on. Absolutely dead on. The first time I think I met you, or it was like within the year I met you, some guy almost took a swing at you on a stage in Singapore at a G7 meeting. He was so angry with you. How do you respond to, OMG, the dollar's dead, renminbi ascended? Do you throw chalk at people at Berkeley when it comes up? How do you respond?
No, at Berkeley I don't hear it, but that kind of interchange, you get more invitations.
You get some more speaking fees off that. Do you suggest the dollar is at risk given all these stresses?
I think the dollar is not at risk yet. So we in the United States can do things to damage its credibility, but nothing that happens at the BRICS summit this weekend will much affect the dollar.
You weren't invited, were you?
I would have chosen to come here anyway.
The word yet is so loaded. Barry, thank you. This was wonderful. Trudy, thank you very much, sir. We are about 5 minutes out from the opening bell in New York City. This is what we're going to do. So at 10:05 Eastern Time, you'll have an address from Chairman Powell. We'll take that live and in full on Bloomberg TV and on Bloomberg Radio. Bloomberg's Mike McKee is going to react to that, and also Mohammed Al-Arian, just the perfect guest to spend a little bit of time with Tom off the back of that address from Chairman Powell.
Can I just say the team that's put this together, and McKee years ago, I mean... Are you
emotional?
McKee, I'm emotional
on the edge
now.
of tears?
We have, no, not at the edge of tears, it's too cold. Lipsky, Eichengreen with us, Gorgieva before, Lagarde later, Dr. Al-Arian, and that. This is just so cool, and I didn't think it would be this cool even 5 weeks ago. That's how immediate this meeting has become.
On the edge of tears, 1 hour and 25 minutes into the program.
Well, I just saw the first elk out there. It's over Bramo's shoulder.
Are you going hunting later?
No, they wouldn't let me do that.
TK hunting in a bow tie?
Keep it like, have a drink.
To a bear.
To a bear,
To
exactly.
a bear.
That's
Okay.
a bar.
Your opening bell is about 5 minutes away. From Jackson Hole, Wyoming, good morning.
large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The week ain't over yet. The final trading day of the trading week. Your equity market on the S&P 500 positive. Futures up by a third of 1%. Up on a week, but only just. On the Nasdaq, up on the week and up again. Up by 0.2% and trying to bounce back from yesterday's losses. There's your opening bout. Switch on the board and get to the bond market. We look like this in treasuries right now. A 10-year yield, cycle high in the past week. 436, back to about 425. Yield nudging up just about a basis point. 35 minutes away from Chairman Powell. The dollar showing a touch of strength. The euro some weakness. Earlier on today, a break of 108, a 107 handle. More weak data out of Europe, Germany specifically, through most of this week. That currency pair at the moment, 108, Tom, 05.
Hey, the correlations are, John, are germane, but I'm not seeing a breakdown like in strong Swiss franc. That really hasn't happened. The real yield hasn't popped through from the shock of 2% to a new level. But as I mentioned earlier, to me, the news yesterday, you take the 3-month T-bill, and I think you got to go back to Eisenhower's presidency over where it is. I'm kidding there, but you got to go. We're starting to go back along Eisenhower, John, president, just coming out of World War II.
Thank you, Tom. Thank you.
But the idea here, we've lost scope and scale as of the people here of where these yields are back before 2007.
We'll do Churchill in the next hour. How about that? Does that work? Yeah, okay, cool. Yeah. About a minute into the session, your equity market positive by 0.4%. Any excuse. On the Nasdaq right now, up by about a half of 1%. Lisa trying to bounce back after a pretty dreadful day of losses off the back of Nvidia, when Nvidia looked pretty decent in yesterday's session for the best part of 5 minutes.
There seems to be a fear that people got overly complacent with the soft landing narrative. And to me, that has been the theme of this week, the slow transformation into Fed Chair Jay Powell. If he seems complacent, what that means for the long term. If he's not, and he pushes back with hawkish rhetoric, which some people think he will, in order to keep inflation under control, what that does to a market that is priced to perfection.
Or is it just simplicity in that if we do get disinflation, if it breaks down, and there's many people, David Rosenberg, Ed Hyman of Evercore ISI, if we get their outcome, do yields just naturally come down? Is that the massive bet that's really in doubt this late August?
I can't bet on what he's going to say at 10:05 Eastern time. I'm on the same page of people who believe there is an incentive here to say nothing. I think he's highly incentivized not to say much at all. But again, Lisa, there has been this conversation about a higher R star, a higher neutral rate. I think when you talk to people around here, there's a reluctance to really subscribe to the idea that he's going to talk about that later on this morning. Why would he?
I can't imagine that he would. I mean, honestly, he's got no incentive to do so. So it's unclear whether this is going to be a market-moving kind of speech. What people are talking about is the tone, and whether he has a hawkish tone, a dovish tone. Does he talk about pain? Does he talk about soft landing? Does he talk about what he sees in terms of his future
dinner plan? Did you just say is the chairman of the Central Bank of the United States going to talk about pain? Did you get that on the Brandon's camp?
But it's the tone. It's all about the tone. But to me, it's indicative of the importance of this meeting that the head of the South African Central Bank spent 30 hours getting here. Ueda, probably governor of the Bank of Japan, probably spent just as long, if not longer. They all came to this spot to look at these mountains, to talk about inflation, because they all are flummoxed. They don't know what to do right now, and I think that's important.
The confusion, and as Lipsky said, Dr. Lipsky, a former of the IMF, said, the complexity right now is over. It's different than 07, 08, 09. I remember the sweat then. It's different. This is not like Lehman, but it's just as complex as well.
At risk of sounding too much like you, TK.
We don't want that.
What does it come down to? It comes down to one thing, doesn't it? It comes down to the data. We've still got another CPI print. Let me get through it. Let me go through it. It's painful enough, all right?
This is really painful.
We've also got a payrolls report next week, next Friday. Okay.
Oh, next Friday. I'll be here.
September 13th. Good to know. September 13th, CPI. September 20th. September 20th, the Federal Reserve. We've still got to get through that to think about what they do in September and beyond. And if we still see GDP prints like the one we're like to get in the third quarter in early 2024, then the idea that this is done and dusted, I think you can park that idea pretty fast.
It's a 2-year, 3-year disease in the pandemic of asking too much of our central bankers. They're just going to look at the data. That's what they've done. Over the history of this event, back to Paul Volcker in the 80s. Do you know they got Volcker here just to do fly fishing?
I do understand that, yeah.
Yeah, I didn't know that.
It's the Kansas City Fed Symposium, right?
Yeah, and it was somebody said, well, why is Kansas City in Wyoming? But that goes back to the huge history of these central banks.
Do you want to do that history now?
No, I don't want to do that history now. Stephen Whiting is going, yeah, I read that in my economics. Joining us now from New York here, an important conversation with the markets opening with Stephen Whiting, Chief Investment Strategist, Chief Economist of Citi Global Wealth. Stephen, I got to cut to the question of the moment within the tension of the market. What is the temptation to go to cash?
Well, it's a huge one. It's the highest yield on the curve is at the front end. We don't have depressed equity markets. The Federal Reserve has been tightening for a couple of years, and so that's really drawing a lot of interest. And again, is it going to be something that's going to outperform over the long run? You could take a look at the history of cash, and it really lags behind both bonds and especially growth assets, equities. And in terms of having a portfolio, you don't want, again, to sell your family business over what can be a yield that usually lasts maybe 6 months at its peak level before the Fed cuts.
Steve, moments from now, Chairman Powell's going to walk out here and, to Tom's point, stare and point at some mountains, and then we'll all listen to him speak in about 30 minutes from now. Steve, from your perspective, from people you speak to, are expectations high for him to say anything at all later on this morning?
No, expectations are not high, or I would say there aren't very strong views as to what he would say. Obviously, he's not going to say, well, we're going to let our guard down on inflation. That's not going to happen. But apprehension, anxiety over the possibility that you learn something that you're not positioned for, that creates trouble for investors. And one of the things you can see right now are record high levels of short positions in futures and 10-year notes and 2-year notes. It's a lot like where we were in the equity market at the beginning of the year. We see a lot of shorting of bonds right now. And again, we could end up seeing some relief after all of that apprehension ends, regardless of what he says.
Steve, there was a big question yesterday about the move in NVIDIA, and this question reigniting by Michael Hartnett of Bank of America about whether we're seeing tech stocks become interest rate sensitive again. Suddenly it matters that yields have climbed as much as they have. Do you think that that's going to be a more predominant narrative yet again over the next few months?
Look, interest rates will always matter. Whether or not it becomes the predominant issue depends on other fundamentals going on at the same time. I'd bear in mind that when you have, companies that have doubled, that have tripled in the year, okay, well, you don't think that they're going to be raising their earnings and their guidance and this sort of thing for companies that have become really huge. I mean, the Magnificent Seven U.S. tech stocks have accounted for something like 70% of the whole total return in global equity markets this year. So that concentration issue, that level of positioning, these things become important. And if you give them higher interest rates on top of that, that can be an excuse.
How have you shifted over the past couple of weeks when we've had this roller coaster of emotions, soft landing, basically baked in, given suddenly maybe it's too strong, maybe we have too much dynamism, rates are going to go up much further, and that's going to curtail some of this. Have you shifted any of your positions or beliefs during all of this time?
So for the U.S. economy, we are getting upside surprises. We're seeing that this year's growth rate is going to be stronger than last year. But I think everyone who believes that the economy can somehow escape any slowdown, or the labor market, which has outperformed the economy so much, can escape any slowdown in the coming year, I think that that's going to be the wrong point of view. And in fact, I would expect Chairman Powell to reflect on the fact that consumer finance rates have moved up a great deal. Not only that, the number of banks who are lending in the economy and doing so the way they did a couple years ago has changed. So monetary policy has tightened a lot. I do not in any way believe that these lags in policy have disappeared. Markets may be fast, but the economy is still slow. Now, I would say there has been some good news. We need to have a recession. What I mean by that is we've been able to keep employment and services growing for so long that it's supporting goods demand, that we're getting inventories down. That's usually the kind of thing that happens when we're coming out of a recession. So in many respects, I think the declines that you see that are very real in housing and manufacturing, we've managed to take some of these losses of recession already. Our outlook for next year is 1.8% real GDP growth in the U.S.
Stephen Whiting, everyone at this time, the complexity, the tensions of the moment, everyone turns to the Citi Surprise Index. What does the Citigroup Surprise Index tell you right now?
Well, it's showing remarkable strength, upside surprises, but they're wearing off a little bit. Once everybody has adjusted their view higher, it's harder to keep them surprised. Now, if you take a look at China or the European Union, we're having big downward surprises, and everyone adjusts their views to that. And so it's never static. If we take a look at the next year, we can never assume that these surprises really continue and that you're going to have just a static view of outperformance of the U.S. economy. That's something I'd be cautioned a little bit about. Now, that's even as we do think, again, just as I said, the American economy can probably have rolling recessions, take its losses in some sectors, and because of the instability of the last few years, actually grow slowly below trend for a couple years and get through this without a collapse everywhere. But again, I make one little point again for the Fed. In a period when they've inverted the yield curve, where they've tightened this much, the potential, the vulnerability to an outside shock is higher. And we saw this again 18 and 19 after policy has tightened and COVID came along. I don't want to say too much about that, but again, the possibility of having to absorb a shock with tight policy is something that you'd want to be aware of.
Steve, none of us want to talk about COVID either. Now, forgive me, away from here, the most important development in the last 24 hours is not anything anyone's got to say around here. It's about what happened with NVIDIA. They come out with earnings, Steve. They knock it out of the park. And I know you can't do single names, but surely you have to take some signal away from the earnings, which were fantastic, and the way the market responded to it, which was less than fantastic. What's the takeaway from that, Steve?
So John, you cut out for a second, but I think I'm going to try to answer your question, hopefully appropriately. We have just made moves into U.S. equities, specifically in equal weight indices, to not build up our concentration in the Magnificent Seven. That, again, wonderful companies that grow their earnings extremely well, and when they sell off sharply, if they have secular power behind them, you want to buy them. But when they have already galloped higher and generated so much return in such a massive market cap, we don't want to increase our exposure again and double up exposure in companies that have succeeded so much in the marketplace this year.
Steve, thanks for dropping by. It's good to catch up as always. Steve Whiting there of Citi Global Wire. Steve, thank you. You know the cheat guide to interviews, TK. You hear something you don't like, you didn't hear it.
No, it's great. It's great. I think our guests do better when they can't hear our questions.
What was that, NVIDIA? What, single names? No, single names? What, NVIDIA? No, you cut out, John.
You know, we have a global audience today with all that we're doing here at Jackson Hole. Mrs. Bramo emailed in.
What did she say?
She said, let's go to Walt Disney. Born on a mountaintop in Tennessee, greenest state in the land of free, raised in the woods so he knew every tree, killed him a bar when he was only 3.
All right.
Davy,
that's right.
Davy Crockett.
My mom was correcting my correction of you, saying bar instead of bear.
Bramo.
Yeah,
No.
that's just no.
When Tom says bar, do you really think we're thinking bear?
Exactly. Do you think that anyone, you said, like,
No,
I was looking
you
for
say
a bar.
You were looking for a bar. I'm like, yeah, what's new? I'm not thinking bear.
He's like, wait a second, I was cutting out.
It's actually pretty serious up here, Lisa. You were out hiking around. I took a hike too.
Yeah, how far?
But there's signs up, and what's interesting is some of the signs have like, magic marker on them. It's a mom with cubs.
Yeah,
we're not kidding.
Don't mess around with that.
It's serious. Up at Jellystone Park, the people are taking the kids and they're going right up to the bison. You don't do that.
No.
I mean, I don't know what these people are thinking.
Tourist TK.
Yeah.
Tourists. We're at one with our environment, a TV studio. Coming up shortly, Chairman Powell. 10:05 Eastern Time, 8:05
so
local.
it's like 20 minutes away.
20 minutes
I get
away.
the time zones
We've got the
messed
clock
up.
ready to go. The clock is ready to go. Chairman Powell just around the corner, and responding to that, Mohammed Al-Arian and Michael McKee. Looking forward to all of that. And Tom, in just a moment, Christina Roma.
She's an expert on the Depression. If you have fears of our history, she is the expert.
The former chair of the Council of Economic Advisors. That conversation up next. Your equity market higher by 0.4%. From Jackson Hole, this is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
When we talk about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%. It's, for me, much too early to think about a pause. I think we have to wait for the next numbers.
Joachim Nagel of the Bundesbank, the president speaking to Michael McKee. This is a single mandate central bank. It has an inflation target. It is not the Federal Reserve. It's the ECB. And that ECB in the last 12 months, Tom, dare I say, has looked a lot more like the Bundesbank than it did under Mario Draghi in the previous decade.
That was brilliant. You're expert on this, John. I'm going to be speaking with Christine Lagarde. And within an academic conference, folks, I can't say to her, what are you going to do September 16th?
You can.
So instead, I'm going to go to John Farrow and say, John Farrow, what is the ECB going to do September 16th?
Such a tough spot. I don't know. I really don't know. The backdrop for them is so different to the United States. We have really robust growth. If they had robust growth, I think they'd probably hike again. I think they would, but they don't. They have parts of the economy facing recession, Tom. Inflation's still sticky. The nightmare word in the last 18 months was stagflation. You certainly can't throw that around in the US economy. I think you can start mentioning it in Europe, and they hope they don't get stuck there.
Then how do you, and it won't be discussed here, but how do you overlay a war in Ukraine with conventional monetary policy.
I don't think you
understand
can. That's what they've been facing. That's what they've been facing. Lisa mentioned this, and Lisa, when you said it, I think you're just dead on. The fact that things are so fragile over there that you can see something like a strike in Australia sending European gas prices through the roof all over again. That's how vulnerable they are to outside forces. Yeah. And not just that, China's another great example of what's taking place in the European economy at the moment. And the US, I think, has the luxury to speak differently about these issues. Europe does not. They do not have the insulation that the US economy has.
And one of the big existential questions here that has to do with that difference is where the fiscal impulse really played into that. The stimulus that the U.S. put into the economy during the pandemic that Europe did not, that is still percolating out into consumer spending.
We're going to have that this afternoon. Christine Lagarde, she will speak here after Chairman Powell. John, what, 15 minutes away on Chairman Powell?
17,
right
something like that, yeah, TK.
Chairman Powell will speak, and then Christine Lagarde will speak. She will answer questions here among the assembled, and then we are thrilled for Bloomberg to bring you our conversation with Christine Lagarde on her paper here, and maybe a bit on the European Central Bank. This is a great moment, and this is, first of all, there's Adam Smith in economics. The modern name for Smith is Romer. AEA did a survey, and there's like 42 economists, world-class name Romer. There's a laureate, Paul Romer, on technology, some guy named David Romer as well. And Christina Romer joins us now from Berkeley, iconic on the history of our nation's economics. I have to tell this story. It's one of the great stories. You're like 22 years old, you and David Romer, I don't even know if you were married at the time, and you literally flipped a coin at MIT over who would get Stan Fisher and who would get Rudy Dornbush?
It's true. Now, in fact, David thought he won, but it turns out I think I won.
You won with Rudy. Good morning, Dr. Fisher, I know, watching this morning. You are definitive. What an honor I had to meet Anna Schwartz in the last years of her lives. Tell us the history, the prism of all the fears that our listeners and viewers have. This is going to be like the Depression. This is going to be a crisis. Do you feel that way?
I have felt that way in the past. Take me back to 2008, and knowledge of the Great Depression was strangely relevant. I don't feel that way now, obviously. I think things are, going pretty well. We're getting inflation down, and the economy so far is holding up.
Are we asking too much of our central bank?
We are asking a lot. It's amazing they're delivering so far. It's way too early to declare victory, but they're threading that needle.
Rudy Dornbush would have talked about, if he was here, he died tragically, folks, of cancer far too early. If Rudy Dornbush was here, it would be a dollar-centric conversation. In your study of our slowdowns, how does dollar worry fold into this? Should we be afeared of a weak U.S. dollar or a dollar that loses sovereign ability?
I don't think so. I think I feel very strongly the dollar kind of follows from what we do on other policies. So I think the main thing we worry about is the Fed doing the right things, is Congress and the President doing the right things on the fiscal side, is our banking system sound. Those are going to be the fundamentals.
There's also a question in your study of the Depression of what the response will be from the U.S. government if there is some sort of downturn, the inability to stimulate further because of how big the debt load is, because of what they've done and where borrowing costs are. How much do you think that affects the likelihood of a recession when you look not next year or the year after, but down the line that could last a much longer period of time?
I'm not very worried about that. I'm worried, right? So just the high debt loads in general kind of limit the fiscal response. I've actually done research that shows that that's the case. Certainly was the case during the global financial crisis. And so we ought to get our fiscal house in order. So we've got both tools to use. I think the Fed has made it very clear they're not going to be afraid to raise or lower rates, if that's what the economy needs.
Have you ever seen deficits this large with unemployment this low?
Well, I mean, yes, right? Because big deficits tend to go with low unemployment. Think World War II, right? The last time we were at 100% was when we had this very, very low unemployment. So in the short run, it's good, right? So you're stimulating the economy. We talked about how that fiscal impulse early in the pandemic was really a big part of why the U.S. coasted through.
I've been dying to ask you this question. Everyone from the left and the right have talked about it. Can you make an analogy to the economic carnage after World War II, 1947, starvation, the Marshall Plan and all that? Can you do an analog to 1947 over to the double deflations that we saw in early Eisenhower? Should we worry about the deflations of the early 50s, that same analog?
I don't think so. I mean, there were sort of special things going on. There were price controls coming off with Korea. So I think that I wouldn't worry very much with that. I think we're in, I think, a much more kind of normal. We've had inflation.
Oh, come on, Christina, half of America feels like they're flat on their back. I mean, the disaggregation, I mean, Meltzer would kill me for this. The disaggregation of the economy right now is appalling. Half of America feels like they're flat on the back. What is the public policy that we can prescribe for those people?
I mean, it's a tough one because I agree, inflation makes people really mad. And that is, I think it's why it's so important that the Fed, really get back to their 2% target. I think there's just no question on that. But there's also the case, if you look at the basic fundamentals, for heaven's sakes, the unemployment rate is 3.5. GDP has continued to grow. I think, yes, people are struggling. They're certainly struggling with the cost of living, but a lot of the fundamentals are good.
You sound very positive. A lot of people have. Are people here taking a victory lap?
They shouldn't. And if I had to guess what Chair Powell's going to do, he will not take a victory lap. He will be cautious. He will say we've still got a ways to go because everybody else is doing the victory lap for him.
You can feel a little bit of happy talk around here, can't you? It just makes me uncomfortable.
No, and I agree. I think that we don't know what's going to come. We have still had a bunch of monetary contraction come in. It's not really hit us yet, and it could.
Oh, you think it has? Because Bill Dudley, the former New York Fed president, is arguing to some extent that maybe those lags are shorter. We've seen them. Everything they've done's already hit us. You think it's out there in the distance into next year?
I think it certainly could be.
Interesting. Christina, wonderful. Thank you so much.
Were you with Dudley at Berkeley when he took his PhD? Were you there?
I think we're trying to wrap that up there, Tom.
I can just see the fist fight.
Thank you. Just say it.
Thank you.
I can just see the fist fight.
You know how this works. It's just this thing called a commercial break.
She's got claws. She's tough.
He didn't hear. His IFB went out.
Oh, is that what he did?
Yeah. That's what happened.
Selective hearing.
There's a bar over there.
Always.
Yeah, what do they serve at the bar?
I'll do it for a fourth time. Christina, thank you. Christina Roman of UC Berkeley. Appreciate it. Thank you very much. Your equity market's just about positive on the S&P 500. 10 minutes from now, Chairman Powell in Jackson Hole, Wyoming, addressing, I would say, not just this audience, but the global economy as well, Wall Street and beyond. Tom, a very, very different speech is expected from the one we got 12 months ago.
Well, a different speech from 12 months ago, John. This is a different speech from 4 weeks ago. I feel like I've never seen in Jackson Hole things have changed. Even back to 2009, back to Lehman, things have changed in 4 weeks.
Chairman Powell in the next hour on Bloomberg Surveillance, live from Jackson Hole. Good morning.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Heading into Jackson Hole, we're not expecting a major policy shift out of the Fed.
I think Powell will be prudent, best of both Greenspan and Volcker, not claim victory.
Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit.
I still think he's going to embrace that narrative of higher for longer, just given how resilient the incoming data has been.
I don't think we should be looking for any big surprises. My sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is almost the moment you've been waiting for. The most important hour of the week, arguably of the month. Chairman Powell addressing Jackson Hole, Wyoming in about 4 minutes from now. The third hour of Bloomberg Surveillance starts right now. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Going into this, your equity market on the S&P 500, slightly positive by 0.4%. TK, this event about global structural shifts in the global economy and all of that good stuff. We've got one question. Tell me about September. Tell me about September and beyond.
It's going to be data dependent. We know that. The shock of last year's speech being 7-8 minutes or whatever, truly a shock, folks. I really can't say that enough. And, the headlines will come out here and Mr. McKee will warble gaily and away we go.
TK, I'll share this with you. 12 months ago, I raced off set to go to the bathroom.
I remember
Go to the restroom. And then I raced back again. I couldn't believe it was only 8 minutes long. There is a sense, Lisa, this is longer. It's more thoughtful. It's less just about inflation and much bigger themes. There is a hint from other people but I'm not sure where it's really come from. The neutral rate. Are we going to talk about R-star? I would suggest to take a guess that this has come about because the economic data has been so much stronger over the last several months or so that people are starting to have that discussion. They'd like him to have that discussion. Whether he chooses to have it 3 minutes from now is a completely separate question altogether.
And most people would say, no way, he's not going to do it. And you say, you know, what are you going to do in September? He's not going to say. He's not going to say what he's going to do later on. But what is going to be interesting is the longer that the speech is, the less clear the message he's trying to convey. Short, very clear. Pain, we need to get there. We need to get inflation under control. Is inflation going to be the same enemy this year that it was last year? Is inflation at 3% pernicious or acceptable? And I don't think he's going to necessarily weigh in on this, but the tone that he takes will really give a sense of that.
I got this message just moments ago from a Bloomberg subscriber. Thanks for that. It said, come on, Jonathan, get with the program. You're in Wyoming, dress like Michael McKee.
Good morning, everyone.
Chairman Powell stepping up to the podium. Here's the chairman of the Federal Reserve.
Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. Today, I will review our progress so far and discuss the outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome. But 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, Demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the 2-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, Growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year, but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
We will keep at it until the job is done. Chairman Powell, 12 months later, after promising pain, without much sign of it, 300 basis points later, the goal is still the same. 2% is and will remain our inflation target. The price action off the back of this address in Jackson Hole, Wyoming, shaping up as follows on the S&P 500. Equities elevated, and it stays that way. The S&P up just a little bit on the S&P 500 right now. If we can run through the boards, we get equities up, and then we can get bonds, and we'll do it piece by piece and start with stocks. Stocks are still positive on the S&P 500. Yields look like this, Tom. They're lower by 3 basis points on a 10-year, 420.39.
Dollar comes in. Let's go right to it, John. Euro, a little bit of dollar weakness with the euro 107 earlier, and come out to a 108.04 maybe with a little bit of a euro lift here.
Knee-jerk reaction, Tom, but I would be hesitant to define this speech based on the intraday price action on the S&P 500 in the bond market. That was a Federal Reserve chairman effectively telling us all, Lisa, that the job is not done, and if we need to do more, we'll do more.
This was a Fed chair saying, stop talking about 3% as the new normal for inflation. 2% is what we're going to get down to. We are not going to stop until we get there. The long and variable lags are long, but they are going to come to fruition. He talked about how there is tightening that's going to hurt. But to me, that is the takeaway. They are not entertaining a 3% target for inflation, despite a lot of people saying that maybe that's what they ought to do.
Perfect Jackson Hole morning, and with the food spread that we've got laid out in support of our staff here, the crows descend and